Welcome to the only guide you'll ever need to successfully sell put options for consistent passive income. This will be a step-by-step guide for absolute beginners on scaling up and learning everything needed about selling put options so you can be successful, have low risk, open, close, and manage each and every single put option that you sell for it to be profitable. This full guide is for two types of people: beginners to options, or option traders with experience who just want to get a little bit better at selling puts and knowing delta, knowing the strike prices, knowing the expirations to pick, how to manage the position from the very beginning of entry all the way to closing for a profit. If you're not making a full-time income from option trading yet, the answer is very simple. I'm going to show you how to do so. I have many students who just focus on selling puts in general, and that's why I'm making this 2-hour course, because I think you don't need to have many strategies. If you understand how to sell puts properly, you can make a ton of money. I have students who are making $5,000 to $8,000 per month with this strategy, and they're in retirement. They don't have to worry about volatility. They don't have to worry about stock picking. They're using this strategy on some simple stocks, and they're doing it every single month for consistent monthly cash flow. So first, if you're not familiar with what an option is, buying and selling calls or puts, and how options work, watch my Options for Beginners full course. It's a 4-hour course. I'll pop it up on the corner of the screen right now, and it goes over multiple different strategies and everything a beginner needs to know about option trading. This course will focus more so on selling put options for beginners. Here on the screen now is everything that I'm going to be covering in this course. There will also be timestamps in the description because I respect your time. So if you want to go through the play bar and see what works for you and what you want to skip, that's your business. That's completely up to you. My goal here is to give you all of the education and everything that I know and what I've learned working on Wall Street, working at Goldman Sachs, getting a finance degree, and just transferring my knowledge and experience to you so you can be profitable, and hopefully in return, you share some of your wins with me and subscribe to the channel. That'd be awesome. First, let's start with the basics. Before we dive into selling puts, it's crucial to understand what put options are. A put option is a contract that gives the buyer the right, but not the obligation to sell a specific stock at a predetermined price, called the strike price, on or before a certain expiration date. When you sell a put option, you're on the other side of that transaction. You're agreeing to potentially buy the stock if the buyer exercises their option to sell it to you at the strike price. For example, let's say a stock is currently trading at $50 and you sell a put option with a strike price of $45. The buyer of that option has the right to sell you 100 shares of the stock at $45, no matter where the stock price goes before the option's expiration date. If the stock price falls below 45, say to 40, the buyer might choose to exercise the option and you would be required to buy 100 shares at 45, no matter what, even though the stock is trading for less. That's the risk that you take. I'll cover later in this course how to make the risk essentially zero, how to make it almost a risk-free trade where you profit and you're happy every single time that you open a put position, because selling put options is safer than stock trading and it's actually high income. I'm going to show you a report of making 3.4% per month on average.
Now, let me explain to you how this works. By the way, this is an article that I have used back when I was at Goldman Sachs. And this article basically states, I'm going to go over this most important part. So selling puts is a higher yield and less riskier way than buying stocks. So this is coming from Goldman Sachs, not myself. So over the past 10 years, selling listed 1 month at the money puts in S&P 500 stocks allowed investors to collect 3.4% per month in premiums and showed a 7.1% annualized return with a 12% standard deviation. Let me explain to you what all of this means and how I've been able to actually beat this return by a lot. So basically, if you had invested in the S&P 500, you would have made 7.3% with an 18% standard deviation. However, selling puts at 1 month actually had a 12% standard deviation. So it was a lot lower risk. In fact, it was roughly 33% lower risk than holding stocks. So selling puts is safer. However, the returns are not that appetizing, but I found a way around that and how to make a lot more money. Put selling offers the same return as equities with lower drawdown risk. That means that during 2008, when the market went down over 30%, put selling actually only went down 20%. However, you can see in this chart something that is actually unusual, which is put selling under the S&P 500 raw return. That means the S&P 500 usually performs better, but selling puts is safer. The way I've gone around this is by just not selling puts on S&P 500. The reason why this is not a good strategy on the S&P 500 is because the S&P 500 has very, very low volatility. You'll see how later when I do single stock put selling, I'll be making way more than 7% per year, which is pretty ridiculous. That's like nothing, right? I'm making around 4 or even 5% per month by selling puts.
But here's the twist. If the stock goes lower and you have to get assigned, as the seller of the put option, you actually get paid a premium up front for taking that obligation. That premium is yours to keep regardless of what happens. Whether or not the buyer decides to sell the stock to you, you've already collected the premium up front and it's cash in your account. So even if the stock falls below the strike price, that premium provides a buffer to reduce your overall risk. It reduces your overall average cost. And if the stock stays above 45 and the option expires without being exercised, well, you still get to keep the premium. And now you get to do it all over again. You get to sell puts as often as you like, as much capital as you have. Because when you do sell a put, you should be cash secured. You should have the cash available to buy 100 shares if it goes to the strike price. We'll talk about managing that position from A to Z in just a moment. So why would anyone want to sell put options? The key reason is the premium income. Selling put options is one of the few strategies in the stock market that allows you to generate income consistently without having to wait for the stock price to go up. The premium income is immediate. You receive it at the moment that you sell the option contract. This means you can collect cash flow regularly, almost like getting a paycheck from the market. And whether you want to get a paycheck on a weekly basis, on a bi-weekly basis, on a monthly basis, even I have some students that want to just get paid quarterly. They just want to sit back, collect a quarterly income, and basically live their life in retirement. I think that's beautiful. You get to choose that. You get to pick the expiration, and I'll talk about best expiration selection later on in this course. But it's not just about cash flow. When you sell a put option, you're essentially getting paid to agree to buy a stock at a price that you'd be happy with, okay? That's what it all comes down to. If you're a long-term investor who believes in the company's fundamentals, this can be an excellent way to acquire shares at a discount. Check out this example right here.
So selling put options is absolutely genius, and let me show you an example of how to do that. So first of all, as I'm making this course, it is taking me a long time to do it, and you can see here how my portfolio is almost at $4 million. I've been trading super successfully. I'm super proud of myself and the community for getting really good results. Now, let me just show you what selling a put option looks like. I have so many sell put options, okay? And I have multiple different expiration days. So what I like to do is I like to go for a high quality company. So let's say that I want to sell a put option on NVIDIA. So if I go to NVIDIA, I'm going to show you what selling a put option looks like. I've actually been selling put options on NVIDIA for a long time. If you see different prices, it is taking me multiple weeks to make this course, so excuse me for the changes in the price. All right, so I have a sell put at 130, a 129 sell put, and a 132 sell put. All of these options right here are making me money, actually $11,810 at this very moment. So these put options right here are an example of me trying to get assigned the stock and actually being excited to own the stock, but getting paid in the meantime to wait for a good entry price. So I'm deciding that I want an entry price of around 130 or 129 or 132. So I am selling puts at this strike prices because I would like to get assigned and have NVIDIA. So let me show you an example of how I would do that from scratch. So I will go to trade NVIDIA options. Then I will go to sell put option. So you want to sell a put option, and the expiration that you want to usually choose, as we've been talking about in the course, can be anywhere from 30 days or 60 days or 90 days. You do get paid in direct proportion to how much time is left on the option. So, let's go for example, December 20th, okay? This is about 40 days or, 30 days as I'm making this video. So let's go to 148, let's go to sell put, okay? And then if I were to scroll down, I'm going to be looking for a delta of around 30, which is roughly my sweet spot. Right? If I go to 138, perfect. So I have a 30 delta here. The volume is 649 and the open interest is 10,339. That is a very good open interest, and the volume here is also very good. Now the bid-ask spread is 515 and 530. That is pretty good because the difference here is $15. Now the tighter it is, the better, because then you get a better fill rate. you lose less money. Imagine if this was $5 and this was $10. That would be pretty bad, because if you were to be selling this option, you'd be losing a lot of money. And if you'd be buying this option, you would also be losing a lot of money because of the non-liquid options. These are very liquid, so this is perfect. And I would go for a 138 sell put and collect $515 right here. You can see how I would basically be making money as long as Nvidia would stay above $132.85. Now, how come I only start losing money at this point, since this option strike is 138? Well, the way this actually works is you actually will be assigned that 138 if Nvidia goes to 138 at expiration. Now, before expiration, you don't have to worry about assignment. I'll cover that in a little bit, but as long as it's above 138, you're good. Even if it's at 139 or 140 or 138 and 2 cents, it's okay. As long as it's above, you're good. Now, if it's below and there's still time to expiration, you're also still good. You just want to make a judgment call. Do you want to close this position? Do you want to roll this position? Right? And we'll get into that shortly. So 138 is the strike price, okay? But the reason why your break even is 132.85 is because here you're collecting $515 or $5.15 per share. And that's why you need to put that into account. So you take the 138 and subtract the premium that you collect, which gets you a break-even price of 132.85.
As you just saw in the example, it is genius to sell a put option, because regardless of what the stock is trading at, just like you saw, it's going to look the same for basically every trade. It's always going to be a lower average cost than the current stock price. So let's use another broad example. Let's say you have a stock at 100, you sell a $100 put. Well, you're always going to get paid for risk, right? So whatever that amount is, let's say it's $1. Now your average cost is 99, right? Because you get paid $1 when you sell a put. So you're always getting a better price than someone that wants to just buy the stock right now. Someone buys it for $100, you're basically buying it for 99 because you're getting paid $1. So it's always advantageous to sell put options. It's more advantageous than just buying the stock, unless, of course, the stock explodes in value, because a sell put option is going to give you pretty much a steady income, but it may not give you a huge income. It might not get to 20% per month, 30% per month. No, but it can provide you a very safe passive income for retirement, where you can generate the income that you need for retirement, whether that's $5,000 or $10,000 or whatever your goal income is per month. You can achieve it by selling put options, and you can just use this one strategy and achieve retirement. That's right. The worst case scenario is, when you sell a put option, you get assigned stock that you like, because you should always be basically selling puts on stocks that you like. I think it's crazy if you sell puts chasing volatility and chasing premium. That's a really big mistake. I see that all the time. I see a lot of my students, well, to be frank, before they're my students, they're chasing premium. Once I show them the math that when you make 2-3% per month and you compound that and you look at your yearly return, say it's 30-40% per year, you start to realize that these numbers really add up. You can really make a sustainable living by just selling put options. So I want you to understand that it's all about safety and consistency. For me, at least. I'm being a little bit biased, and this is a beginner's course, but I still want to teach you the framework and my mindset, because I think mindset makes a really big difference in trading. So I want you to understand risk management. I want you to really understand that what the worst case scenario is and how you can avoid the worst case scenario, because I'm a safe investor. So you're going to, when you're selling put options, you're going to be getting a stock that you like at a discount. Essentially, you can think of selling puts as a safer version of buying regular stock. It's superior in every way, except when the stock shoots up, you won't be able to profit nearly as much as a regular stockholder. But when the stock goes down or goes sideways, you're going to be smiling a lot. And you're going to be laughing all the way to the bank in literally 11 out of 12 months. That's pretty much my results. I win almost all the time. Some months can be bad, but they're always better than the stockholder. So even in the bad months, I'm outperforming, because when you sell a put option, it's out of the money usually. We'll talk about out of the money and in the money options. But for now, think about out of the money as a safe zone. If a stock is at 100 and your strike is at 95, it's above your strike. You're in the safe zone. Well, technically, it's all the safe zone because you're happy to buy it. But an out of the money option is simply when the strike is not currently in risk of being assigned. Okay. So if you have a 95 sell put, The stock's at 100, you're above 95. If the stock's at 98, you're still above 95. If it's at 94, well, there's some chance of getting assigned. You might get put some shares, right? The person who bought the put option, they may decide to give the shares to you. That usually doesn't happen early. I'll explain why later in this video, but it usually does not happen early. So you don't have to worry about early assignment. It rarely ever happens. Actually, let's talk about assignment real quick, okay? When you sell a put option, there's a few different scenarios that can happen, okay? First scenario is when you sell a put option, as long as it's out of the money, say you sell a 78 put. The stock's at 200, giving you a crazy example. You got nothing to worry about. It's going to expire out of the money. The stock's at 150. You got nothing to worry about. It's very far. You got, no chance of getting assigned, all right? So that's the first scenario. You're well in the green. Everything is calm and relaxed. Now, the second scenario is that stock is very close to your strike price. So say you have a 78 strike price and the stock is at 78, 78.01, 78.03, something very, very close. You guys start thinking about, do you want to get assigned? Do you want to close the position? Pretty much, I don't even worry about it because again, I'm selling puts on stocks that I like. So it doesn't even matter. If the stock price is below your strike price, you're going to be assigned and that chance increases the closer you get to expiration. So there's 3-4 weeks out, you really got nothing to worry about. Here's why.
Now I want to show you how it would make no sense at all for early assignment to happen. So this is the same NVIDIA option. We're gonna look at a sell put example, okay? And I'm going to pick the 150 sell put here, okay? So check it out. Let's say that you've sold a 150 put, all right? However, now your option is in the money, all right? It's in the money. So NVIDIA is below 150. You might be thinking to yourself, oh, I'm worried. I'm worried that I'm going to get assigned. But the chances of getting assigned before earnings, before expiration, is very low. And let me explain to you how low it actually is. So if your stock is below 150 in this example, think about it from the shoes of the buyer. Someone who bought the put option, if you think about it, they're 150. How much are they in the money? Well, if they bought at 150 and the stock's at 148.74, they're up $1.25, correct? Because they're $1.25 in the money. The stock is $1.25 below 150. So if they were to exercise, they would basically save or make or have a value of about $1.25. But look at the option. It's worth $10.55. So it would make absolutely no sense whatsoever for someone to want $1.25 when they can just trade the option for $10.55. This is very clear and very obvious, right? It's a very big discrepancy. But let me show you something even shorter term. Even when there's like a couple days left, even this option right here, it's super, super close and the discrepancy is going to be very little. However, even when there's a few days left, the chances of getting assigned are still near zero. In this example, 149, we're a little bit in the money. The option is still $3.40. And this would only be in the money by 25 cents. So this would still not make any sense at all for someone to want to exercise early.
All right, so we talked about why early assignment usually doesn't happen. I want you to understand, you will still make money even if you get assigned. This strategy is not about being greedy because chasing huge price movements is only going to backfire in the long run. Now, I want you to understand, even if the stock price never drops to the strike price, you still pocket the premium for your efforts. It's a win-win scenario when you execute correctly. Executing correctly is actually the easiest thing when you sell a put option because as long as you're doing it on a high quality stock, you're going to be in good shape. Let's talk about how to maximize your success with this strategy, okay? I'm going to tell you all the different things that you need to be aware of. There are 3 critical decisions that you're going to need to make every time you sell a put option. Number 1, choose the strike price, select the expiration date, and understand the premium you're going to get paid. Let's break each one of those down. The strike price is the price at which you agree to buy the stock if the option is exercised. Ideally, you want to pick a strike price that's lower than the current market price of the stock. The reason for this is simple. If the stock drops, you'll be willing to buy it at a discount. Again, even if you sell a put option at the same exact price as the stock, you're still technically getting a discount because you're collecting income. But it's even better when you can find a sweet spot and sell a put option that's already out of the money and you get paid. So now the stock falls 2% and you're completely unaffected. You've collected 1% income for the week, let's say. Stock falls down 2% and you're like, I don't really care. It's still out of the money. It still has not reached my strike price. So for example, if a stock is trading at 50 and you sell a put option with a strike price of 45, and think about it, you're getting a $5 buffer, which is amazing. That means if the stock falls from 50 to 48, everyone has lost $2. You're still unaffected. Let me finish you the point on why the stock option might be showing you a loss, even though it's still out of the money. Because a lot of people get confused. If the option's out of the money, how can the option itself be showing a loss? Well, that's because the chances, again, of that option have increased and they've gotten higher for the option to get into the money. And since the option has increased in risk, it's closer to the strike price, the value has gone up, okay? Let me explain to you, and this is what I do in my coaching program. I give analogies, okay? So imagine that you can invest in people. Pretend that somebody is going to be a doctor, and a doctor makes $300,000 per year. So if you were to be able to buy a person, which you can't, but let's just say you were able to bet on that person's income, you know they're gonna make $300,000. Say it's gonna happen for 10 years. Now, you know that, right? So you'll bet, $300,000. Now, if you were to have an option on this, okay, and that person has good grades and they're continuing to be in med school and becoming a doctor, you'd be comfortable, right? Nothing changes. However, now let's say something bad happened. Let's say that person got into an accident, or they started smoking and drinking and skipping classes and getting bad grades. You would probably rethink your option a little bit, right? That person, he or she is still in medical school. They're still going to be a doctor most likely, but the chances of becoming a doctor have gone down. So your risk has gone up, right? Because that person has gotten bad habits. The same thing happens with an option. When the option gets closer to the strike price, it's becoming more risky. Doesn't mean that things are going to be bad. It just means at this moment in time, it is a loss for you to buy it back. The good news is you don't have to. You don't have to buy it back, because when we sell a put option, it's not a single person we're betting on, right? A person is very risky, right? A person, even a good student, might have an issue, an accident, or change of behavior, let's say. But a company, a solid company, a high quality company, an Apple or a Google, right? These are strong businesses with brands, lots of employees, a long track record, big market caps, big brand, big cash flows, strong profit margins. If you pick companies like this, then you could be very sure for yourself that, hey, even if you get assigned, that it's fine. You're happy to get assigned. You're like, sure, Apple is at 200. Now I get to buy it at 170. I'm happy to buy it at 170. 170 might not even happen. If it happens, you get to buy it. That's the beauty of selling puts. You have a lot of control and you put yourself in a win-win situation. Next, I want to talk about expiration date. Every option has a specific expiration date, and this is the date by which the buyer has to decide whether to exercise the option or to let it expire. The expiration date is important because it affects the premium that you receive. Shorter term options like 1 or 2 weeks out will offer lower premiums, but you'll know the outcome of the trade more quickly. Longer term options like 30 to 45 days out will offer higher premiums, but your capital will be tied up for a longer period of time. Many experienced traders prefer selling options with an expiration date of around 30 to 45 days. Some of my students like more weekly income, so they go for 5 to 7 days. This strikes a balance between collecting a decent premium and not having your money tied up for too long. Keep in mind, there's a lot of flexibility with options. So you can sell 1 week options, 2 week options, and monthly options. Nothing's stopping you. Because selling options in general, from my research, working at Goldman Sachs, I found that selling options has been extremely profitable. It doesn't really matter what expiration date you go. In my opinion, 1 to 12 weeks is perfectly fine. Options decay in value as they approach expiration. So a 1 week option has more decay, and it's decaying faster than a 1 month option. For that reason, you could make a point that weekly options are slightly better than monthly options, but they are more work and the compensated amount of money that you make is very minimal. Let me show you an example right now.
Weekly income versus monthly income. This is a big debate within my Discord community, and many folks like to go for weekly income because it's more attractive and they like the frequency of it. However, I want to argue the point that weekly income and monthly income are very, very similar. So if I go to sell put for Apple and I go for something that's going to expire in roughly a week, and I go for the 225 strike here. So this would get you $126. Okay, that would be 1 week. But if we go for a 1 month option, okay, and we still go for the 225 option, is going to be $370. So the fact of the matter is, weekly option trading is a little bit more profitable, you can say, because this is $370, okay, and before we were looking at an option that was going for $126. Well, 126 times 4 is going to be about $500. So in a week, you can make, let's say, about $500, but in a month, you can make about $370. However, let me tell you this, that if you're doing short-term options, A, you have to do a whole lot more work. B, in a week, a lot more can happen, whereas in a month, the stock will stabilize a bit more. So the reason why you get paid a little bit more on a weekly basis is because there's more risk and there's more work to do with managing the position. However, on a monthly basis, you get paid less, but you lock it in at a much safer rate, okay? So there's actually a discrepancy here. Weekly income is more attractive in terms of returns by a little bit, but investing in monthly income is safer and more passive. And on a long-term basis, I have not found there to be that much difference between weekly trading versus monthly trading. Although I will admit weekly trading is slightly more profitable, but I would say that the returns of weekly trading are only about 0.1 to 0.5% more per month. So if you think about it, yes, you can squeeze out an extra 5% per year if you're selling weekly options. However, the risks are going to be higher. You're going to have more variance. It's a lot more work, and it's a lot less passive, and it's more active trading.
Finally, let's talk about premium, the payment you receive for selling options and selling put options to be specific. The amount of premium depends on several factors, including the current price of the stock, the strike price, the time until expiration, and the stock's volatility. Volatility is a key factor. The more volatile a stock is, the higher the premium you can collect because the risk of the stock price moving significantly is greater and you get compensated for that risk. It can be very awesome being an option seller. It is very awesome. But keep in mind that with higher volatility comes higher risk, as the stock price is more likely to drop and cause you to be assigned on the shares. Again, if you don't mind getting assigned, that's fine. If you're selling puts on stocks that you do mind getting assigned, you really shouldn't be, but it can be very lucrative to chase higher premiums and higher volatility because that's more money in your pocket. Now that you understand the mechanics, let's dive into a strategy that you can use to consistently generate income from selling puts. This strategy is straightforward, but it's highly effective, especially if you stick to it over time. Step 1 is picking the right stocks. You don't want to sell put options on just any stock. That is the biggest mistake. The key is to focus on high quality companies that you'd be happy to own if you're assigned shares. Look for companies with strong fundamentals, solid earnings, and a long record of stability. These are typically large, well-established companies with strong balance sheets. Think of Apple, Microsoft, Johnson & Johnson, Google. I've mentioned some of these stocks already, but it is imperative that you just stick to top S&P 500 stocks if you want consistent cash flow and you want retirement income. Otherwise, you're going to experience more volatility. It's also less beneficial to sell put options on smaller cap companies because they have less liquidity in their options. They have worse bid-ask prices. They have worse volume. They have a lot worse conditions for a put seller. Step 2 is choosing conservative strike prices. The strike price is critical because it determines your risk level. I'll be honest, if you go for higher deltas, you're going to be assigned more often, and that gives you less margin of safety. The more conservative your strike price, the less likely it is that the option will be exercised. And at the end of the day, less chance of being exercised, even if you pick high quality companies, less chance of being exercised is still going to be lower risk, but the lower premium that you're going to collect. So it is a direct trade-off. Some of my students ask, why don't we just sell options and sell puts that have a 2 or 5 delta? Very low chances of things happening is cool, very low risk, but it's also very low return. And you probably want to balance your return. And I would say very low returns are just not that attractive. Why would you be selling options looking for small income? You should be looking for big income, big consistent income. So a good rule of thumb is to choose strike prices that are typically 5% or maybe 10% below the current stock price. And that's why I like to look at options that are a 30 delta. When I show you the research later on in this video, you will see that I go for 30 delta because it gives you the best mix of both return and low risk. And this is where delta is very important because delta helps you accurately choose a proper strike price and manage your risk very effectively. And delta is going to be something I'm going to cover in great detail later in this course. Going out of the money gives you a cushion in case the stock drops, but also make sure that you're not taking in too much risk. Step 3 is to keep the expiration date short. Options that expire in 30 to 45 days offer a sweet spot for premium collection, lower risk, and not that much work as much as weekly options are. They provide enough time for you to earn a decent premium without tying up your capital for too long. Shorter term puts, honestly, plus, these options reduce the likelihood of major market events. So it is really beneficial to go shorter term in many ways, but a 1 month option is honestly also considered short term. But selling weekly puts is even better in many ways. Better because you get a lot of feedback, and in 1 week, usually not that much happens. So when you sell weekly put options, you get to see your results and you get to count your money every single week. So it can be really fun. But for me, as someone who is retired and working with other folks that are trying to get to retirement, I do like to go to 1 month. It's a little bit lower on the income, a little bit, but it's just way more consistent and it's way easier to just manage. The beauty of this strategy is that it can be done repeatedly. Once the option contract expires, whether it's exercised or not, you can simply sell another put and collect another premium. This creates a cycle of consistent income generation. Even if you're eventually assigned the shares, you can still sell covered calls on the stock to generate even more income, a strategy we'll save for another video. Now, let's address a common concern. What happens if the stock drops significantly and you're assigned the shares? This is where risk management comes into play. First, if you've chosen high quality companies that you believe in for the long term, owning the stock at a discount shouldn't be a problem. In fact, it can be a great opportunity to buy a stock that you love at a lower price. What if the stock drops much lower than the strike price? Here's where the premium you collect upfront provides a cushion or a margin of safety. For example, if you sold a put with a strike price of $45 and collected a $2 premium, your actual cost basis for this stock is $43 per share. This means the stock would have to fall below 43 for you to start losing money. And even then, you could choose to hold onto the stock until it recovers or sell covered calls to generate additional income. Risk management is crucial when selling put options. One of the biggest risks is a sudden sharp drop off in the stock's price. This could be due to market crash, bad earnings, or some other unforeseen events. To protect yourself, consider selling puts on multiple stocks across different sectors. Diversification can help you reduce the impact of any stock's price drop significantly. That's why I always recommend having 10 to 15 stocks in your portfolio. Another way to manage risk is choosing stocks with lower volatility. Volatility can be measured by looking at the stock's implied volatility or by using the stock's beta. Beta is not something I mentioned on this channel, but beta gives you the understanding of how a company compares to the overall market. So a 1 beta means that the stock would move equally with the market, and a 2 beta means the stock is twice as volatile as the market. So now you might be wondering, how much money can you really make from selling put options? Well, the answer depends on the stock, the strike price, and the expiration dates, and of course the capital that you're investing. Typically, you can expect anywhere from, on the low end, 1 to 3% of the stock's value per month. On the higher end, 2 to 4% per month, depending on the stock's volatility. That might not sound like much at first, but it adds up quickly, and over a course of a year, you can make something like a very small return of 12%, which, to be honest with you, I haven't made, or my average return, which is roughly in the ballpark of 30 to 50%, because I am collecting premiums that are roughly 3.4% per month on average. So if you look at the annualized return of that, it's actually really big. If you have a portfolio that's 50K plus or 100K plus, selling put options will definitely add up. For example, let's say that you sell a put on a stock worth $100 and you collect a premium of $2 for a 1 month contract. That's a 2% return on your investment in just 1 month. If you can repeat that process every month, you'll end up with a 24% yearly return by the end of the year, far exceeding the average stock market return. And if you're selling puts on multiple stocks, your income potential increases even more while reducing your risk. Selling put options is all about consistency and stacking those premiums month after month. Over time, those premiums can compound, helping you to build wealth and generate a steady stream of passive income. Let's be clear, selling puts is not without risk. While this strategy is less risky than buying stocks outright, there's still the possibility of being assigned shares in a down market. As I'm going to explain shortly, I actually consider it pretty much a non-losing strategy with almost no risk at all. But I want to explain to you what the risk is if you do get assigned and why it can be bad, although it's usually not. If you're not comfortable owning the stock or managing the risk, this strategy might not be right for you because you don't want to sell puts on stocks that you don't like. It's important to be prepared for the possibility that you could end up holding that stock during a market downturn. We can't predict market downturns, so when you're selling put options, you should definitely like the stock that you're selling put options on. That said, if you follow the strategy that I've outlined, selling puts on high quality stocks, choosing conservative strike prices, and keeping your expiration dates short, you'll put yourself in a strong position to succeed. You'll put yourself in a very strong position to succeed. That's the fact. The key is to be patient, disciplined, and stick to your original plan. Plan accordingly. Over time, you'll see how selling put options can become a powerful tool in your financial arsenal. Honestly, if you want to retire early, you should be selling puts. It's such a fantastic way to generate passive, consistent income. You're getting paid upfront, reducing your risk, and potentially acquiring stock at a discount. It's a strategy that can work for both beginners and experienced option traders. If you want to fast track your journey to financial freedom and retire early, selling put options should definitely be your number one or your number two tool in your option trading. So what's next? Well, start by researching high quality stocks that you like to own. Practice selling small conservative put options and track your progress. Now that you understand the core strategy and how it works, let's get into something deeper, more advanced techniques that can take your put selling game to the very next level. While selling puts is already a great way to generate consistent income, there are methods and nuances you can apply to further optimize your returns, reduce risk, and build a portfolio that can lead you to financial independence. One key concept we need to understand is the idea of cash secured puts. You may have heard of this term before, but if not, let's break it down. When you sell a put option, you're agreeing to potentially buy 100 shares of a stock at the strike price. If the stock drops down below that strike price, you get assigned at expiration. You'll be obligated to buy those shares. For example, if you sell a put option on a stock at a 50 strike price, that means you're agreeing to buy 100 shares at $50 per share each, or $5,000 worth of stock. A cash secured put means that you have the cash available in your brokerage account to cover that purchase if the option is exercised. In our example, that would mean having $5,000 in your account ready to buy the stock if necessary. This is essentially the risk management strategy that you need to be aware of because it will happen from time to time and you need to be ready to acquire stock. But if you like the stock, basically there's no issues at all. This is an essential risk management strategy because it makes sure that you won't be caught off guard or forced to sell other assets to cover your obligations. Why is this so important? Without cash securing your puts, you could be left scrambling to find the funds to buy the stock if the option is exercised. Worse, if you don't have the cash and your brokerage account is on margin, you could face significant interest charges or even margin calls. By keeping your puts cash secured, you're not only protecting yourself from financial strain, but you're also ensuring that your trading strategy is both conservative and sustainable. Let's take a moment to look at why this approach is so effective. Cash secured puts are an extremely low risk way to enter the stock market compared to buying stocks outright. Think about it. If you want to own a stock but don't want to buy or pay full price for that today, selling a put basically effectively sets your own entry price. You get paid a premium up front, and if the stock drops to your desired level, you get to buy it at a discount. So you get paid to buy a stock for lower than the stock's current price. On the other hand, if the stock doesn't drop and the put expires worthless, you've just pocketed the premium without ever having to buy the stock. Either outcome sounds amazing, right? But it's important to understand that selling naked puts plus puts without the cash backing them up is much riskier. And for the purposes of this guide, we're focusing on the safer, cash secured approach that can help build long-term wealth. Now, let's dive into some specifics of choosing the right stocks and the right option contracts to sell. Remember, the core idea here is to only sell puts on stocks that you wouldn't mind owning anyways. If you're selling puts on speculative or high-risk stocks, you could end up owning shares of the company that's not really a company that you want to own. And if there's a serious downturn, which could end up happening, you would end up tying up your capital in a not so favorable company. That's why I recommend focusing on blue chip companies with strong cash flow. well-established businesses with strong fundamentals and a track record of steady growth. These are stocks that you can feel comfortable owning, even if they experience some short-term volatility. But how do you choose the right stocks? Here are a few criteria to keep in mind. 1, financial strength. We're investing in businesses. We need them to have strong financials. Look for companies with strong balance sheets, consistent revenue growth, and healthy cash flow. Those are companies that can weather economic downturns and are much less likely to experience significant long-term declines in the stock market and stock prices. Now, also look for industry leaders. Focus on companies that are leaders in their industry. These are businesses with competitive advantages, whether it's through market share, brand strength, or proprietary technology. The likelihood of long-term appreciation in those stocks is much higher than in smaller, less known companies. Another excellent characteristic is to look for companies that pay a high dividend. If you do get assigned the stock, owning a company that regularly distributes dividends adds another stream of passive income on top of the premiums that you've already collected. So paying dividends is actually a very good green flag on a stock. Once you've identified a stock you want to sell puts on, the next step is choosing the appropriate option contract. Here's where the balance between strike price, expiration date, and premium really comes into play. As I mentioned earlier, it's often a good idea to sell puts with a strike price of 5 to 10% below the current market price. This creates a cushion and increases the odds that you won't have to buy the stock at a higher price than what you're comfortable with. But it's also important to consider stock volatility. Higher volatility means higher premiums, but also greater risk that the stock price will drop sharply and you'll be assigned the shares. For example, a technology stock might offer a very attractive premium, but the risk of a big price swing is much greater than, say, a consumer staples company like Kraft Heinz or Procter & Gamble. When it comes to choosing the expiration date, remember that short-term options provide faster income, while longer-term options give you more premium, but you have to wait a longer period of time. Typically 30 to 45 days until expirations. That is the strike that strikes me with the perfect balance. Pun intended, I guess. You've given the stock enough time to move in your favor or to not move at all, because when you're selling put options, you don't actually need a move in the stock. The stock can just go sideways, and that would be pretty good because you end up collecting your premium and nothing really happens. Now, if the stock moves down, you end up buying a stock that you're potentially excited to own anyways. Now, here's an advanced tip. The timing of selling your puts can significantly impact the premium that you collect. Premiums are influenced by a variety of factors, but one key factor is implied volatility of the stock. Implied volatility measures the expected volatility of a stock over the life of the option and directly impacts the option's price. When implied volatility is high, option premiums are also high, and that's a good time to sell options. When implied volatility is low, option premiums are also low. So how do you use this to your advantage? One way is to sell puts during periods of market uncertainty or volatility. Although many people are afraid and there's fear in the market, for me, that's actually exciting. I'm actually happy to sell puts during that time. For example, when the market dips or during earnings seasons, implied volatility tends to be really high. It spikes. So by selling puts during these times, you can collect higher premiums than you would during a calm market. However, keep in mind that while higher volatility brings in higher premiums, it also increases the chances that the stock price may move against you. This is why it's important to sell puts on stocks that you're comfortable owning, even in volatile market conditions. So the market pulls back, you end up getting assigned, you're fine with that. Another advanced technique is known as rolling your put option. As you guys know, I do love rolling options, but it is a case-by-case basis. And during my one-on-one coachings and where I send texts and trades, I do focus a lot on rolling because a good roll can really adjust a losing position or further the gains of a winning position. Rolling involves closing out an existing option position and opening a new one with a later expiration date or a different strike price. This technique can be particularly useful if the stock price is close to or below your strike price and you're at risk of being assigned the shares. Instead of letting the option expire and potentially buying the stock, you can then roll the position forward, collecting additional premium and pushing the expiration date further into the future. For example, let's say that you sold a put option with a strike price of $45 and collected a $2 premium. The stock is now trading at $44 and the option is set to expire in just a few days. You're at risk of being assigned the shares, but
But instead of letting that happen, you could buy back the put option that you've sold, close out the position, and immediately sell a new put option with a later expiration date, perhaps 30 days out or 60 days out, and a similar or slightly lower strike price. This allows you to collect more premium and defer the risk of assignment. Essentially, you're giving yourself more time for the stock to move in your favor, and you're adjusting the strike price. So you're able to manipulate that strike price by several dollars. And in most cases, in 30 days, you won't have any negative consequences. You can typically roll for zero cost if it's just a few dollars in 30 days, or you can roll by much more than a few dollars if it's more than 30 days. Rolling options is a more advanced strategy, but it can be highly effective in situations where you want to avoid buying the stock at the strike price or when you believe the stock price will recover over time. It also enables you to continue collecting premium income, which can add up significantly over the long run. At this point, you might be wondering, what are the implications of selling put options after collecting regular premium income? That sounds great, but how is that income taxed? In most cases, the premium that you collect from selling put options is considered short-term capital gains. That means it's taxed at your ordinary income rate, which would be higher than the long-term capital gains rate. However, if you hold the option for more than 1 year before it expires or is exercised, the premium might be taxed at a long-term capital gains, which can result in a much lower tax rate. If the option expires worthless, the premium is taxed in the year that the option expires. If you're assigned the stock, the premium is factored into your cost basis for the shares. For example, if you sold a put for $50 strike price and collected a $2 premium, your cost basis on the stock would then be $48 per share, not $50. Not all brokerages do this, and taxes vary from state to state, and rules can vary with the IRS, so please do consult a professional tax advisor and don't take this as tax advice. I have a lot of experience, and I always try to keep it very simple. So for me, I'm always basically trading short-term capital gains. I'm paying a lot of money on taxes for my option trades, which is completely fine with me because I'm beating the market by well over triple and quadruple in majority of the years. It's also important to obviously consult a tax professional to understand how selling puts can fit into your overall tax strategy. Taxes can significantly impact your overall returns, and strategies that minimize your taxes and like tax loss harvesting, like towards the end of the year, I typically sell a lot of my stocks at a loss because I want to do some tax loss harvesting and actually improve my tax bracket. Let's break down how this could work in practice. Imagine you have a portfolio of $100,000 and you're targeting a conservative annual return of 12 or let's say 24%, right? 2% per month. Very, very realistic. This would mean earning $24,000 in premium income over the course of the year. So broken down monthly, you'd be aiming to generate about $2,000 in premium every single month, 12 months out of the year. Depending on the stocks that you're targeting, the strike prices that you choose, and the expiration dates that you select, this could be achieved by just selling multiple put contracts across different stocks. And honestly, it could take like 30 minutes a week, not that much more than that to just get 2% per month. 2% per month is actually on the lower end. I have many students that are making 4% or higher because they're selling puts on more volatile stocks like Nvidia. So diversifying your put selling strategy is key to reducing risk. You don't want to concentrate all of your options on one stock or even one industry. By spending your put contracts across several high quality stocks and spreading that risk around, you reduce the risk that one poor performing stock or industry will negatively impact your overall returns. For example, you might sell puts on technology, consumer goods, healthcare, and financial stocks. Make sure that your portfolio is balanced and not overly exposed to any one area in the market. Here's another tip to optimize your portfolio for long-term success. Reinvest your premiums. Just like dividend reinvestment, where your dividend payments end up buying you more shares of stock and then there's more shares paying you more dividends, you want to do absolutely the same because this creates a compound effect that each new premium that you collect ends up fueling your portfolio and its overall growth, allowing you to generate even more income with each and every single month that goes by. And don't worry, now I'm just explaining the theory, but I'll get into details of how exactly to do this in practice. If you guys want to basically not feel overwhelmed, diversify into 10 to 15 stocks and perfectly execute these trades and grow your wealth. So let's look at a scenario where you reinvest your premiums. Say you collect $1,000 in premium in 1 month, and instead of withdrawing that money or letting it invest it in cash, you use it to sell another put option. That new contract generates an additional $200 in premium. The following month, you do the same thing. And over time, those premiums snowball, adding significantly to your total returns. This reinvestment strategy can shave off years of timeline to your retirement and financial goals. Snowballing and compound interest is one of the strongest factors, honestly. I know that you might be thinking to yourself, this all sounds good in theory, but can you go over the risks a little bit more, Henry? I really want to understand how to not lose money and collect this safe, consistent passive income and generate a stable return. And I'll say yes, every strategy does technically have some risk. Otherwise, it would be too good to be true. But the reason why I like selling put options so much is that the risk that you're taking isn't really that bad. Actually isn't any risk at all, depending on your mindset. The biggest risk, of course, is the stock price falls below the strike price and you're assigned the shares. Well, this isn't necessarily a bad outcome, especially if you've chosen a high quality stock. It doesn't mean that, you're not going to get assigned. It just means that if you get assigned, you're prepared to hold on to that stock and you wanted it anyways. Say it's Apple or Nvidia or another stock that you really like, Palantir, etc. If you want to own that stock, then who cares? Selling a put option can't go bad. Stock goes up, fine, you made premium. If the stock goes sideways, you end up getting premium, and if the stock goes down, you still got the premium, but now you have a good stock that you like. Now, in a bear market or during a big market correction, stocks across the board can fall, including the ones that you've sold puts on. If you're assigned multiple stocks during a downturn, you could end up holding a lot of stocks that are temporarily underwater. This is why having a cash cushion is very important. That's why selling cash secured puts is very important. This is why having the cash cushion or maintaining a diverse portfolio of stocks and sectors is absolutely crucial. You don't want to be over leveraged or put all of your eggs in one basket. Risk management is about being prepared for both the expected and the unexpected moves in the market. Another risk to consider is the opportunity cost. When you sell a put, you're tying up money that would otherwise be invested elsewhere. So you could technically miss out on opportunities to make money off of stocks that are very bullish or stocks that are paying dividends. And that's honestly okay. I personally know many of my students that are okay with just collecting safe passive income from selling puts. And they don't care about closing out, or having the craziest bull runs or trying to predict the market or time the market. I personally don't really believe in that. As long as you're collecting safe, passive, consistent income, I'm happy. And many of my students are too, because they want to have the low stress and basically have income that helps them not be in their 9-to-5 job and have more freedom. So again, this is not really a bad risk to have at all if you're selling puts. It's basically saying, well, I'm making consistent money selling premiums, and at worst, I'm ready to purchase the stock and get assigned. So although if you have enough capital to buy the shares, there's really no risk at all if you think about it. So I'd recommend to get the best of both worlds: consistent income from selling puts and selling more aggressive puts on the higher volatility and more implied volatility stocks. So one more thing to watch out for is liquidity. Not all stocks have actively traded option markets. That's why I do prefer to stick to blue chip stocks that have healthy volumes. It's very, very important. So I always look at liquidity, and liquidity just means how easily you can enter and exit a position because of how many trades are currently, being placed. So if the volume is good, that's a very good sign. So smaller, lesser known companies are obviously going to have lower liquidity. And as you know, there are two sides of all option trades. So if you want to enter or exit your position, you're going to need someone else to essentially make the opposite trade that you're looking to get filled on. And on small cap stocks, that's just really not possible. The bid-ask spread is really wide and you're going to be losing a lot of money. So it's just really not worth it. If the options market for a particular stock is illiquid, meaning there's a low volume of people trading that particular stock, the bid-ask spreads can be wide, which can impact your ability to sell puts. You're going to be able to get filled, but you're going to get ripped off on the price. The bid-ask spread is just a difference between what buyers are willing to pay and sellers are willing to accept. Always check the liquidity of the option market before selling puts on a stock. You want to trade in a market where there's a healthy level of activity to make sure that you're getting the best price for the premium that you collect. Now, let's shift gears a bit and talk about the bigger picture, how this strategy can help you retire early. The beauty of selling puts is that it provides a way to generate income without having to sell your stocks or other assets. This is especially important for people looking to retire early and live off of their investments. Typically, early retirees rely on withdrawing a certain percentage percentage of their portfolio each year to cover their living expenses. This can be risky if the market experiences a downturn, as you may be forced to sell stocks at a loss to fund your lifestyle.
So what are the next steps? If you're new to option trading, I recommend starting small. Begin by selling puts on a stock that you're comfortable owning, and don't be afraid to experiment with different strike prices and expiration dates. Track your results, learn from each trade, and gradually scale up as you gain more confidence. If you've been trading for a while, consider integrating put selling into your broader investment strategy. Use it as a complement to your existing portfolio and create a diversified income stream that you can weather very different market conditions. But before I go into some more specific examples and show you more live trading and different strategies with selling put options, let's talk about the common mistakes that people make when selling put options. Whether it's picking the right stock, selecting the ideal expiration date, or calculating your strike price with precision, every decision can make a difference in how successful you are with selling puts. One of the biggest mistakes people make is choosing the wrong stock to sell puts on. Many traders, especially beginners, they get excited about high premiums and they see the volatility and they see speculative stocks and they see it as an opportunity. That can be very dangerous. They see a put option offering a huge payout, they jump in without considering the risk, and most of the time that does not really go well. Remember, when you sell a put option, you're agreeing to buy 100 shares of a stock at the strike price if the option is exercised. If that stock plummets in value, you're stuck holding a significant loss. And if you don't like that stock, you're in a very bad situation. For example, let's say that you sell a put on a small cap biotech stock that's trading at $30 per share. The stock is very volatile, but the premium is high. So you're tempted to take the trade. But if bad news comes out, like an FDA trial, a failure, or a negative earnings report, the stock could easily plummet down and drop to $15 or lower. You'll be obligated to buy the stock at $30 per share. Now you're sitting on a 50% loss and you're stuck holding a speculative stock with no guarantee that it'll recover. Listen, when a stock falls down 50%, if you do the math, if you go from 30 down to 15, that's a 50% drop. To go from 15 to 30, you need a 100% gain. You're in big trouble. That's why Warren Buffett says, don't lose money. And rule number 2 is follow rule number 1. This is why it's crucial and it's super critical to only sell puts on high quality, fundamentally strong companies that you personally believe in long term. Not me personally, not your friend personally. I see that all the time. A friend recommends a stock, you buy the stock goes down. Yeah, you're not confident on it because your friend recommended it. Do your own research. It's really important to understand the stocks that you're investing in. You can copy my trades, of course. I have that in my Discord community. You can see everything I'm doing. But even myself, I would prefer to teach you how to do it for yourself so you have that strong confidence. And every time that you enter a stock, you know exactly what you're doing and why you're holding it, and you never lose the confidence. Because once you lose the confidence, you start making more mistakes. Another mistake is selling puts with strike prices that are way too aggressive, just way too aggressive. New traders often think that because they don't mind owning a stock, they should sell puts with strike prices that are very close to the current market price or even slightly above. While this will give you a higher premium up front, it also significantly increases the likelihood that you'll be assigned the stock. The key to selling puts successfully over time is to give yourself a margin of safety. Aim for a strike price that is 5 to 10% below the current strike price. This way, if the stock experiences a short-term dip, you won't immediately get assigned. You'll still have some room for the stock to recover before you're forced to buy it, which is very important. That margin of safety is really a game changer. Now let's move on to the third mistake, ignoring implied volatility. Implied volatility is one of the most important factors in determining the price of an option contract. Yet, so many traders overlook it when selling puts. IV represents the market's expectation for future volatility, not past, future. Okay, so when you see IV, it's what the market's expecting. It's, hey, we think there's gonna be a lot that can happen here in the near future. So selling puts when implied volatility is low means that you're collecting less premium for taking on lower risk. On the other hand, selling puts when implied volatility is high can result in much higher premiums, but it also increases the risk that the stock will move significantly against you. So the trick is, as most things with life, you need to find balance. You need to find balance to where you sell options, the strike price and the expiration. Ideally, you want to sell puts when implied volatility is a little high, but not so high that the stock is extremely volatile. This way, you can maximize premium you collect while minimizing the risk of large, unpredictable price swings.
Another mistake to avoid is not managing your trades properly once they're in play. Once they're actually in play, the management of the strategy is the most important. Some traders make the mistake of setting it and forgetting it. While that is fine for many trades, it's not always fine in every situation. They sell a put, they collect a premium, and then wait until expiration without actively monitoring the trade and understanding that if it goes into the money or hits a strike, what they should do about it. While selling puts is often a relatively low maintenance strategy, it's still important to keep an eye on the stock's price movement and market conditions because they can change. And if the stock drops below or close to your strike price before expiration, you may want to consider rolling out the option to avoid assignment. This gives you more time for the trade to play out while collecting additional premium. Lastly, let's talk about the mistake of overextending yourself. Selling put options requires cash-secured approach, meaning you should always have enough cash in your account to buy the stock if the option is exercised. Some traders make the mistake of selling too many puts all at once, tying up more cash than they should. This not only increases the risk in your portfolio, but also limits your flexibility if the market moves unexpectedly. Be mindful of your cash reserves and don't sell more puts than you can comfortably cover, okay? It's much better to start small and scale up as you gain experience and confidence than to go, all out right away and to sell a bunch of put options and then, have way too much get assigned to you and all of a sudden you have no cash, you have no flexibility. And, it's not that bad because selling a put, you get into high quality companies, but still, you want to scale into the market. Now, I want to talk about how much I will recommend as a percentage of your portfolio to allocate to cash secured puts and how that would look like, okay? So I have a lot of students that they love a certain stock and they just invest tons of money into one stock. That could work, but let me tell you what the best practice is. And let me actually pull up my portfolio right now and show you like a real example of how this is actually called asset allocation. It's extremely important. It's actually what Goldman Sachs really focuses on. They focus on asset allocation with their clients. So look, my portfolio is currently at over $3.6 million. I've been on this journey for a very long time, over the past 10 years, and I've learned a lot of this stuff from Goldman Sachs, from working in the industry, and from getting a degree in this. And I want to say that asset allocation is something that's very overlooked from an investor standpoint. A lot of investors just completely overlook this, and I think it's one of the biggest mistakes. Because look, asset allocation means how much money you have in each position, which means that asset allocation is really your risk management. It's really how much risk you have on each position, all right? If I look at my portfolio, I'm going to go into some of the stocks that I hold, and I have many sell put positions, but obviously at some point you do get assigned on a sell put, then you start to have stocks, all right? And that's where I run the wheel strategy and other videos that I do have on this channel that you can check out around the wheel strategy. But look, when it comes to selling puts, you want to have similar asset allocation to what you want your end goal to be like, right? Let me explain that. If you are selling puts 10% of your money and you have 10 positions, that's good. If you want 10 positions in your portfolio, that's really good. So for example, if I go into my portfolio, you'll see I have Apple. I have 41% or 42% of Apple right now, all right? If I go to Walmart, I have 18% of my portfolio in Walmart. If I go to PayPal, I have about 6% of my money in PayPal. So when you sell puts, you want your end goal to be this. I'm okay getting assigned this put. If I own this put, I'm okay to have 6% of my money be in this put or this position. And that's how you want to plan things out. You want to have your end goal in mind from the beginning. Isn't that interesting? Planning ahead. So when it comes to my recommended percentages of your portfolio and how you should allocate it, it does depend on your personal risk preferences, but I'll tell you a rule of thumb. You should have 10 to 15 stocks. Some of them should be a little bit higher in the volatility. So for example, I don't know if I have NVIDIA in this portfolio, I have two portfolios, but Tesla, for example, I just recently bought 1,000 shares of after Tesla's had some volatility. So you can see I'm a little bit down on Tesla. I'm not worried. I put 1,000 shares on the line. I have market value of $217,000 on Tesla, and it's about 8% of my portfolio. So I'm just slightly under my average cost, and we'll talk about average cost later on in this video. But listen, I'm fine with that. I sold some puts. I got assigned, and I'm happy. I'm happy. I bought some shares and I sold puts on this position, and I'm excited to hold Tesla. I think it's a very bullish position for the future. So look, for me, it's 8% of my portfolio. That's perfectly in line with 10 to 15 stocks. I'm not a fan of timing the market, but I do think there is such a thing as good and bad timing. For example, during periods of market uncertainty or fear, implied volatility tends to spike as investors anticipate large price movements. This is often referred to as the fear gauge, and it can be measured by the VIX index. This index, the VIX, tracks the market's expectation for volatility. When the VIX is high, premiums on put options are generally higher, providing an excellent opportunity to sell puts and collect more income. Here's a brief clip of me looking at the VIX.
Okay, so the example that I want to show you using the VIX is actually a very important one because you can learn a lot from the VIX. So over the past 6 months, and I am recording this a little bit in the future as this course took me a lot of time to make, as of like December 20th essentially, you can see that the VIX was really, really low and we were in a really big bull market. So it's really easy to make a lot of money. And it's still easy to make a lot of money into 2025. But there was an economic event with Fed Powell basically saying that, we don't have interest rates under control as much. So this is a big part of the reason why the market went down. You can see how the volatility actually increased from 13 all the way up to 27. It doubled. All right. So check it out. What you want to look for when it comes to the VIX is when it's really, really low, you actually can buy options, and when you're selling puts, it is not as lucrative. So you can sell puts at a much higher delta. Okay, you can increase the delta to 35 to 40, and for some specific stocks that are really safe and have low implied volatility already, you can even sell like right at the money put options that are even 45 delta or 50 delta. Because even selling a 50 delta option, it's still really lucrative. It still is better than just buying stock outright because you get a better price than the current stock. So my portfolio is scaling to $5 million and we're on our way, and we've been making a lot of really good results. I want to go into a position right now to show you what selling a put would look like at the money. So yeah, Apple and Tesla, a lot of the stocks that I picked have absolutely printed money, and I want to take a look at a stock that hasn't risen as much as the market. So let's use Target in this example. So when a stock's at a 52-week high, you don't really want to sell puts. That's why I don't want to pick Apple. That's why I don't want to pick some of the really high-flying stocks. Actually, Nvidia could be a really good one, since Nvidia, at the end of December, if you're watching this in the future, it doesn't matter. Obviously, this course is teaching you throughout all of time how to invest and sell put options for income. The Nvidia right now, the position that I have, is actually really interesting because it's right at the money. You can see here, Nvidia's at 1.2, and I have a position expiring today, which is going to be the Nvidia 132 sell put option. So this is right at the money. You can see how I'm completely okay with that, because what happens is options really decay a lot as they approach expiration. And on the very last day, you can see how Nvidia is going to open up at over 132. So I'm going to make $415 just today on this position. So you can see how options and selling put options, they can really have a big impact, especially when it's at the money in the very last day, which is why I typically recommend that you hold a sell put option position until the very last day, until expiration, because only a couple of things can happen. Either get assigned on a stock that you like, or if it's really close, you're going to make a lot of money in terms of theta and time decay. Or 3, it expires out of the money. So that's fine as well. But you can see here how it's right at the money. So when I'm looking at VIX, this is actually a really good opportunity, because as VIX goes up, right, it's high right now, which is actually a good thing when you're selling put options. So you want it to be higher. Actually, let me tell you this. If VIX is at its very highest, that is the best time to sell put options, because implied volatility is high in the market. There's a lot of fear in the market. And because VIX is inversely correlated to the stock market, meaning when the stock market goes down, VIX goes up. When there's high VIX, it gives you 2 big benefits. One benefit is essentially that high VIX means higher premium. And then high VIX also means that the market has sold off. So you're actually getting a discount. So VIX is kind of like your friend. And when VIX is really low, you should be a little bit more cautious around selling put options. Then again, it is also it's individually based. So if a stock is really low on the RSI, I'm going to cover technical analysis actually a little bit later. But the gist is, to wrap it up, high VIX is a good thing. When it's really low VIX, be careful when selling put options. And when a stock is at a 52-week low, that's a really good time to sell put options. Even if it's not at a 52-week low, that's fine as well. Just avoid stocks that are at very, very all-time highs, because there's better strategies to use when a stock is just going up and up and up, just like buying call options. But if you want to focus on selling puts, which is what this course is about, I'm going to show you some more indicators later on in this course.
If the market is very uncertain and people are afraid, there will usually be high implied volatility. That high implied volatility is actually a good thing if you know how to take advantage of it. During periods of market optimism, there will be usually very low implied volatility because everyone's optimistic and they think that they can predict the market, and that will be a sign that volatility will be lower during those times. And with lower implied volatility, you'll have lower premiums. So you might focus on selling puts with shorter term expiration dates to generate more frequent, smaller premiums. This way, you're still generating income even if the premiums are smaller, and you're minimizing the time that your capital is tied up. You always want to have your capital working for you in generating income. That's my whole goal, generating safe, passive, and consistent income. Understanding market sentiment can also help you identify the best stock to sell puts on. During the bull market, or a strong bull market, fundamentally sound companies tend to perform very well, making them ideal candidates for selling puts. In bear markets or periods of uncertainty, you may want to focus on defensive sectors such as healthcare or consumer staples, which tend to be more resilient, especially because those companies have a lot of cash flow, and strong cash flow is a really good sign because that company has really good stability and more investors will have demand for that stock even in the bad times. So these sectors may offer lower premiums, but they come with less risk of large price declines. Now, going over to the next section, I want to talk about companies to focus on when selling put options. One of the most important aspects of selling put options is selecting the right companies to trade. As I mentioned earlier, you want to focus on high quality, fundamentally strong companies that you wouldn't mind owning if you were assigned the shares. Like Apple, Microsoft, Google, Procter & Gamble. Yep, that's the company that does toilet paper and toothpaste and all that. And Johnson & Johnson, your everyday products. These companies are going to be very strong fundamentally. These companies are ideal candidates for selling puts because they have strong long-term growth potential and their stock prices are less likely to experience wild swings. They have very predictable returns, which is a very, very good thing, especially if you want consistent returns without any of the hassle or the headaches. But I understand if blue chip stocks are quite expensive for you, in this case, you may want to use other blue chip stocks that are just priced a little bit lower in share value. Because when you sell a put option, you do need 100 shares of those stocks. In that case, if you have a smaller portfolio, I'd like to say there are several stocks that I do trade even with a smaller portfolio. So look, we're going to briefly go through my portfolio again. And I want to show you some stocks that are on my watch list that I think are really good and they're priced a little bit cheaper, okay? So first of all, I am going to go down into all my positions and let's change this to last price. So you can see Apple is going to be over 200, Walmart. Palantir is really good. Palantir is a stock that I've been in for a while. Had Palantir since it was $16 per share and below. But now it's at $42. It's a little bit cheaper in terms of price. American Airlines is my golden goose. American Airlines is personally a golden goose stock that I've been trading over and over again. If I click into it and you look at the 3-month chart here, very strong performance. The 1-year chart, strong performance. And the 5-year chart, I wasn't trading it at this level. So if I tap in here, I wasn't trading it in the 20s. I started trading it when it went to $10 per share. And I've been on YouTube since around this time period when it was $10 per share because I've been on YouTube for 4.5 years. Yeah, about 4.5 years ago when the stock fell, this is where I saw an opportunity. I've been trading it ever since. So if you look at 4.5 years ago, it was at about $10. The stock is currently at $13. So over 4.5 years, it has done nothing. But listen, selling put options has been money. It's been a gold mine. So what I do in my Discord, I literally just sell puts on American Airlines over and over and over and over again, all the time. It's easy money. I mean, look at my options right now. I'm up $730. These are recent positions. This is a small portfolio trade. This is small. I'm up $730, and on the stock itself, I'm up $24. It's easy money. Okay, easy money. A stock doesn't actually have to move a whole lot for you to make money. Because as an options seller, you're just looking to capitalize on the premiums. You don't really care if the stock moves up a lot or down a lot or sideways. When you're selling put options, you can comfortably make a very handsome and consistent income monthly in thousands of dollars without even taking on much risk. So it's truly a really powerful strategy. And I want to say that if you're selling options, you can pick cheaper stocks and make good income. I mean, I have Snap here. Snap is very strong around that $10 level as well. I know that I've had HIMS in the past, HIMS. It's a decent company. They do a lot of marketing. They don't have a competitive advantage, guys, just to be frank and to be clear. HIMS is a, they sell Viagra, they sell minoxidil for the hair if you're balding, they sell antidepressants, but their products are just generic, right? They just have generic products. So their secret is really marketing, which is, to be frank, a lot of companies, their secret is marketing. So they don't really have a competitive advantage, so they need to keep their marketing high. And if marketing expenses go up in advertising and Mr. Zuckerberg wants to charge more money for his meta ads, HIMS will have a problem. So be careful with HIMS, but that is a stock. There it is, HIMS right there. It is a stock that you can sell put options on. In the past 3 months, the stock is up. In the past year, actually, this stock is tremendously up. So I have recommended in the past. I'll be honest with you, I'm not a genie, and I have missed out on some of the gains on the upside on HIMS. So I was planning to purchase it, and then I mistimed it. But I didn't make money or lose money, so I'm kind of neutral on it right now. But I think it's a really good stock, especially because it's on the cheaper side. Now, there's some other stocks, like there's Sweetgreens. I used to go to University of Pennsylvania, and I would go to Sweetgreens every day. I mean, I would just eat there all the time. All the time. The salads are pretty good. At the time, though, I was pretty broke, so the Sweetgreen salad was actually expensive for me. Oh, how times. Actually, I was dreaming that one day Sweetgreen salads would not be expensive, because I think I was getting some good salad for maybe $16, because I was getting like extra protein. I was putting a lot of add-ins. I think it was 12 or 16, and I was like, oh, it's really expensive compared to Chipotle, which was like $8. I was spending double on Sweetgreens. I do remember that it was hitting my pocket pretty hard back in college. Pinterest is a decent stock. Oatly is probably avoid that stock for now. It's on my watch list, but I'm not trading it. Other cheap stocks, I mean, yeah, American Airlines is really that golden goose for me. Let me go to search here, and maybe I can find some. So if you go to stock screeners, Robinhood has that feature. You can see there's actually high implied volatility stocks, which is really interesting. High implied volatility. And there's also high options volume, which is really nice. There's 52-week low and there's 52-week high. So actually, if you're trying to sell put options, I would actually do something around that 52-week low. So I would look for stocks that are towards the lower end, because look, when you're selling a put option, you're saying, I'm ready to buy a stock, right? I'm ready to buy the stock at that price. But if it's already at a 52-week low, it's unlikely to go too much lower in theory, right? So yeah, you can take a look here. There's not a whole lot on the Robinhood here. There's only 8 of these. Let me go back here. Let's go to high implied volatility here. Let's go to high implied volatility and take a look. So a lot of these stocks are going to be not ideal. So let me click into, for example, SPI Energy. SPI Energy here, yeah, it's like a penny stock. So this is no good. This is absolutely no good. I would just stick to the blue chip stocks, and look, if you don't have enough, you just need to get the money up so you can do the 100 shares. It's really important. So now I want to talk about another category to consider, which is dividend paying stocks. For example, there's Pfizer, there's Coca-Cola, there's Starbucks, there's ExxonMobil, and these stocks tend to be more stable during market downturns, and they offer very consistent dividend payouts and very good payouts. Selling puts on companies in these sectors can provide a lower risk way to generate income during an uncertain market. Even though they have a dividend, which in theory hurts the sell put, these stocks still have really good fundamentals, low volatility. If you do get assigned on the sell put, you're going to be in a good situation because you have a good quality stock that you're getting assigned on, and getting assigned doesn't hurt. Getting assigned just means that the stock is below the strike price at expiration, and someone wants to exercise their rights to sell you their stock at the strike price. Now, what about growth stocks? Okay, we've talked a lot about value stocks and the Procter & Gamble's of the world. What about growth stocks? Well, selling puts on blue chips or dividend-paying stocks is generally a safer strategy. There's also really good potential to sell puts on growth stocks, particularly during periods of market optimism. Okay, growth stocks are companies that are expected to grow significantly faster than the overall market. And I've actually recently covered a new strategy on my channel, which I've personally made up. It's called the momentum wheel strategy, which is where I find trends on growth stocks to sell puts to get assigned, and then to sell covered calls to run the wheel strategy. That is a strategy that I will drop down in the description, or at the end of this video. When you finish the video, it'll be on the end screen, okay? But I think that selling puts on growth stocks is very viable, and I do that all the time. So I'm mixing things up because I think in this market, we always need to mix things up and innovate and stay on the edge for creating safe passive income. And safe passive income is a good goal, but along that goal, we have to take the necessary action and put in the work and do the research, and that's what my job's about. I really enjoy doing some of that analysis. I don't sit all day and do analysis because I do a lot of one-on-one coaching with students as well, but during my one-on-one coaching calls, I'm doing analysis with them. So all day, it's analysis on the market. I'm always trying to find a good price, whether it's a blue chip stock or a dividend paying stock. I'm always looking for opportunities on growth stocks or more of those stable stocks just to sell puts and generate income. Now, these growth companies, they often reinvest their profits into expansion. These companies are growing quickly. They have a lot of product development and marketing. Marketing is the lifeblood of a company. Companies all have marketing, which typically leads to rapid increases in the stock price over time. That's why we see companies like Amazon, like Tesla, they run at negative earnings for a long time to really scale up their operations so they can one day be very profitable, but they're looking for aggressive growth. Think of companies like AMD, Tesla, Palantir, Nvidia, and Amazon, as I mentioned. These are examples of growth stocks that have seen significant gains over the years. They're not the most profitable while they're growing, but it certainly makes sense for the businesses to invest aggressively to gain market share and to grow. So I also want to say, however, there are a few things to consider when selling puts on growth stocks that may be a little bit different. First, growth stocks tend to be more volatile than blue chip stocks or dividend paying stocks. This means the potential for high premiums is greater, but the risk is also higher. Because growth stocks are more prone to sharp price swings, you could find yourself in a position where the stock price drops well below your strike price and you're assigned shares at a higher cost than you really like. That said, if you're comfortable with the company or you're comfortable with the company's long-term potential, selling puts on growth stocks can still be a very effective strategy. When selling puts on growth stocks, you should be even more conservative with your strike prices because they have more implied volatility and you will get paid. Don't worry about that. You will get paid, but I would recommend you go a little bit more conservative. Aim for a strike price that is significantly below the current stock price, perhaps 10% or 15%, or just go for my standard rule, which is 20 to 30 delta. This gives you a wider margin of safety and it reduces the likelihood of being assigned shares during a short-term dip. And remember, even if you're assigned the shares, growth stocks can recover quickly, especially if the dip is related to temporary market conditions rather than any fundamental issues with the company. Now, another sector that I personally really like is technology. The tech sector has been one of the best performing sectors in the market for years. Year after year, it's one of the best performing. You can see on screen right now, tech is a good performing sector. And also, it is my favorite sector to trade. I have worked on Wall Street at multiple different hedge funds, and I have found that tech sector is the best sector to invest in because there's the most productivity in that sector, and we're getting the most GDP increase, we're getting the most company increase, the most market cap increase. So it's generally growing a bit faster, and I do have a bias for tech companies. As a tech analyst myself, I spent a lot of time researching these companies. I've also spent a lot of time researching brands and consumer companies. So I have a lot of experience there, and companies like Apple, Microsoft, and Google actually offer a bit of both. Okay, they are brands, they're big brands, but they're also tech, right? They're tech, they're software, they're consumer. I really, really like those type of companies. So companies like Apple, Microsoft, and Google are well known for their growth potential. They have very strong balance sheets, and they're also relatively low risk, long-term companies. So they're very good to have in your portfolio to continuously sell puts. Now, I would sell puts every month, every 2 months, every 3 months. You can actually sell puts on multiple different expiration days, and as we will go through examples in my portfolio later on in the live trading portion, you will notice that I'm okay picking multiple different expiration dates. So selling puts on established tech companies can be a very lucrative strategy, especially if you time your trades around earnings reports or product launches, which can lead to increased premiums due to higher implied volatility. We all know Apple goes for that yearly iPhone release, right? The iPhone 16. And during those times, there is a little bit heightened volatility because the market could, not take that with good graces. For example, maybe an iPhone has a delay. I mean, there's always a little chance of something happening, and option market will adjust for that, and they will price that in. So if you're selling options, you will get a little bit more money during those types of periods. That said, it's important to be cautious with smaller, more speculative tech companies. While these stocks might offer higher premiums, they're also much more likely to experience large swings in the price, especially if they're not yet profitable or still in the early stages of growth. Stick with established, financially stable tech companies if you're looking to sell puts for considerable income. And lastly, let's not forget about the financials, all right? Companies like JP Morgan, Goldman Sachs, and Bank of America. These are considered financial blue chips and tend to perform well in both bull and bear markets. These companies also tend to have relatively high implied volatility compared to other sectors, which means you can often collect pretty good premiums when selling put options. Now, let's talk about how to manage risk when selling put options. Something that every successful trader, and I mean every, especially one selling put options, needs to master. While selling puts is generally considered less risky than buying stocks outright, and it's certainly, in my opinion, one of the best strategies because it's part of the wheel strategy, which is the best strategy, but selling puts is the main component of this strategy. I still need you to be aware that there are important things that you need to understand about selling puts and how to manage it, because it's not without risk. By no means is it without risk. The first and most important aspect of risk management is making sure that you have cash secured puts. That means that your account has the ability to buy 100 shares of that stock that you're selling a put option on, right? Which I have already explained earlier in this course and why it's so important. But I want to re-emphasize it because all the positions that I recommend should be cash secured, all right? You need to have the money available, and in that way, I truly believe this is a non-losing strategy. It's impossible to lose because you get assigned a stock that you want to own. You really can't lose because you want to own it and it's a high quality company and you're better off than other people who are just buying stocks. You have a safer price. But please do not forget how much cash you're potentially going to need to buy 100 shares of the stock you pick at the strike price. It's very easy. What's easy to do is also easy not to do, right? Heard that saying before. So make sure you take that strike price and multiply it by 100. And even if you do technically have enough cash in your account, make sure that it's not the majority of your portfolio. Again, risk management is asset allocation. It's figuring out, hey, is this more than 20% of my portfolio? If so, this is way too much. Again, these are the very basic things to be cautious of that greedy investors, especially beginners, will do. And I've covered the biggest psychological tricks to really making a lot of money. It's also a full course that I want you to watch because psychology plays a really big role in how you manage your risk. The second thing is diversification. So if you can afford to sell puts on multiple different stocks or diversified ETFs like SPY or QQQ, that's fantastic. You should be diversified. You should be doing that. And those stocks that you pick should be in different sectors, like I mentioned before, tech, finance, health, and energy sector, and etc. other sectors as well. For example, instead of selling a put only on tech companies, although I love tech, guys, I love tech, but you should be selling puts on a mix of tech, healthcare, financials, consumer staples. That's the Procter & Gamble I mentioned earlier. Consumer staples are those necessary companies in the economy, the toothpaste and the mouthwash type of stuff. This way, if one sector experiences a downturn, your entire portfolio won't be affected. You have different correlations. Some companies perform bad in low interest rate environments. Some companies perform good. Some stocks fall when there's a market crash and some actually hold their value. So you want that diversification. Diversification helps smooth out the overall volatility in your portfolio, and it reduces the risk that a sharp decline in one stock or one sector will have an outsized impact on your total returns. Trust me, you don't want an outsized impact on your portfolio. You want your portfolio just to be chugging along smoothly on an upward trajectory. But for those of you who have small accounts and can't afford to diversify and sell puts, I am going to recommend you something. I'm going to recommend that you use selling puts, but in a little bit more of an interesting way, and turn a put into a put credit spread. Here's actually an example of how you can do that.
All right, guys. Now, when you're selling puts, you can also make it a credit spread. A put credit spread is super powerful because it requires a lot less capital versus just selling puts outright. So I'm going to show you the NVIDIA example again here. We're at 132 and I have a 132 sell put. So what I can actually do, let me show you this from scratch. Let me open up a new position. If you go to sell put, right, and you want to sell a put option, but you're like, it's really expensive, I want to reduce my cost, this is what it would look like. I'm going to go for an expiration day that's like March 21st, 2025. All right, so if I go ahead and I sell a put option, we're going to go down, I'm going to go for around a 30 delta. I'm just going to show you like an actual example that I would literally do myself. I think 118 will be good. So yeah, that's a 30 delta. Perfect. Okay. So look, if you sell this option right here, obviously you're going to need $11,800, but I'm collecting 600. So this is actually a really good example because I'm collecting 600 here, which is why my max loss, I'll explain max loss in a second as well, is 11,200. Now look, this max loss is not really the max loss. This max loss is basically if NVIDIA went down to zero, you would lose $11,200 in this example, but NVIDIA is not going to zero. So you never really have to worry about the max loss. Okay. So whenever you sell a put option, you have to, put up 100 shares times, the strike price. So here we have to put up 11,800, but because we collect $600 in premium, that means that our max loss is only 11,200. So this 11,200 is what we have to put up and we're getting 600 in return. That's really good, right? I mean, that's a pretty good return. What is that? It's actually around 5 or 6%, right? That's, decent. It's not a lot of money, but certainly if you can do this every 90 days, that's a 20% return per year. And, if you have a bigger size portfolio, 100K, and you want to scale it to 500K, then, 20% return, per year is good. It'll definitely get you there to scale up in the safest way possible, right? Selling puts is the safest strategy, hands down. It's safer than just investing in the stock market. So, but if you want to scale faster and if you want to put up less capital, here's what a put credit spread would look like. It's really simple, actually. So instead of selling a put option, now you're just going to go to buy put option. And instead of going for 118, you want to go lower. So we're going to pick an option that's lower than the 118. And this is essentially going to create a cap on how much money we can lose. It's also going to reduce the capital that we have to put up. So I do typically go for a $5 spread, right? But here, since I did pick a little bit of weird number, so if I did 120, I can easily do 115, but I picked 118. So there's no 113 strike price right now on Nvidia as I'm looking at it. So instead, there's nothing wrong with that. You can still create a put credit spread that's not a $5 width. You can create one that's a $1 width. You can create one that's $3. You can create one that's $8 or $10 and so on and so forth. So I'm going to create, actually, you know what? I can create one that's $10 width. All right. So this will be a really easy example. So now what you'll see here is if I go ahead and I buy the 108, now my max loss went from like 11,200, which again, the max loss is not the issue. The issue is that it is capital intensive. For some folks, they don't have all that capital to put up. Most folks do. But, if you don't, or even if you do, you want just more return for less like upfront capital or less risk. Although this put credit spread strategy is a little bit higher risk than selling put options, because when you sell a put option, the worst thing that happens is you get assigned and then, you can run the wheel strategy or, just hold shares. Whereas with the put credit spread, you can't really run the wheel strategy. And if it goes below 108, you do lose the capital that you put in. In some cases, you can roll that. But in most cases, what I personally do is I close the position once it hits in the money. So Nvidia's at 132. If it were to go to 118, I would think about closing out the position so I don't lose the full amount. Here, what you'll notice is that we're going to be collecting a total credit of about $1. And that means that on this put credit spread position, we're going to be putting up about $900 worth of capital. So you make 100 and then you're putting up 900, which is an 11.11% return. All right. Actually, I want to take a look at the bid ask spread as well. The bid ask spread here is not ideal, although I am trading pre-market right now and the market's not open as I'm recording this video. This bid ask spread is really, really, really trash. You don't want it to be this wide. So this is a really bad bid ask spread. And that's why the return is not that much more attractive. What I'm going to do actually is I'm going to show you something. I'm going to show you a much more attractive return. Let's go for January 17. And I'm going to show you the same example, but it's going to be a lot better because oftentimes shorter term expirations do have better liquidity, meaning there's a better bid ask spread since there's just more people trading. So if I go down and I still go for let's say 120. Okay, this is around, a 30 delta. So this is good. This is actually even safer. So if I end up selling this, right? So if I sell, and also I picked 118 and 110 was a little bit weird. So if I go to this and then I go to buy 115, now this will be a $5 spread. Now you can see here that I'm getting $1, a little bit over $1, but now I'm only putting up about $400 worth of capital. This is a $5 width on a spread, but because I'm collecting a total credit of 100, that means it's not really 500, it's really 400. So I'm making 100 on 400, which is a 25% return, and this 25% return comes in 30 days. So this is essentially how you can sell a put, but then you can turn a put into a put credit spread. You can either open up that position from scratch, or what you can do is you can actually sell a put, see what happens, see how it's doing, and then open up a buy order for a put option later on and basically turn a put into a put credit spread. It's more or less the same thing. In just the scenario one, you do it at the same time, which I prefer. If you're going to open up a put credit spread, just make it a put credit spread from the get-go. But there's also, nothing wrong with if you have sold a put option and then you buy a put option later. Let's say that it's going against you, it's going down, you want to buy yourself protection. That's also a really good idea because the buy put option that you purchase, it increases in value when, the stock goes down. So if the stock is not doing so well, I would say it's good just to close out the position in general. But let's say that you don't want to close it out and you just want to make a short-term profit and you think that the momentum on the downside isn't going to be lasting. You just, it's a bad day or it's a bad week or we have a little bit of a bear market in the short term, then it can also make a lot of sense to buy a put option as well.
All right, hopefully that was helpful. So I want to point out that another aspect of risk management is monitoring your delta. If If you don't know what delta is just a metric we use for option contracts to see how likely the option contract is to go into the money, all right? More specifically, delta measures how much the price of an option is expected to change for every $1 move in the price of the underlying stock. Now, delta is a measure on a scale of 0 to 1. You can also have negative delta, I guess, when you're selling options, but let me explain to you in simple terms. A 0.5 delta means that it has a 50% chance of being in the money. For a put option, specifically, delta is on a scale of 0 to negative 1, but a 0.5 or negative 0.5 is still a 50% chance. So the negative or the positive doesn't matter. Just look at the delta. Just keep it simple. Here's actually an example of how I'm going to use delta to show you how to really pick a sell put option using delta.
All right, guys. So in this example, I want to show you how to use delta to select a put option. Delta is actually like one of the most important things that you can do for selling a put option because it tells you the level of risk. Delta is essentially your risk gauge. Okay, so when you look at delta, here's what I look for. So I'm going to use NVIDIA again and January 17 expiration. If I take a look at the 115 option here, as a 20 delta. What that means is there's a 20% chance of this option going down and expiring at exactly 115 or lower. Okay, so a 20 delta is really safe. That means there's an 80% chance that this won't happen, but there's a 20% chance that NVIDIA will go down to 150. So I use delta as a gauge, and for me, I found my sweet spot to be around 30 delta. So I've done a lot of research. I actually took this from a Goldman Sachs article when I was doing research at Goldman Sachs. I think that what I saw was that between 25 to 35 delta was really ideal. It does depend on the implied volatility, but to keep it really short and really simple, you will make money on a long-term basis and you will put the odds in your favor to be successful if you just go for around a 30 delta. So here you can see that NVIDIA has a 0.28 delta, implied volatility is 52. The volume here is amazing, amazing NVIDIA volume. NVIDIA and Tesla, AMD, Palantir, all the stocks that I've made tremendous amounts of money on. If you watch my channel regularly, it's been an absolute money-making machine. And that's because the options are amazing, the volatility is good, and this is the best stock to trade in town, like these big high-flying tech stocks. And that's because volatility is your friend. When there's a lot of volatility, there's a lot of opportunity. So I'm always trying to spot opportunity, and I'm always trying to, tell my students, my one-on-one students, I'm like, hey, this opportunity I see right here. Take advantage of it, make some money. And opportunities, they come and go. When I see them, I always let my students know. So you'll see here that NVIDIA has a 28 delta here, and essentially delta is just, I usually go for 30. Now for selling puts, I will sometimes also use 40 when the stock is just really lower volatility, but I want entry into the stock. If I really want entry into the stock versus buying the stock at the current price, I'll just go ahead and sell a 40 delta or even a 45 delta.
When you sell a put option, you benefit from the stock price staying the same or going up, but you lose if the stock price goes down. Well, let me clarify. You don't really lose if it goes down because it might get assigned. You get to buy the stock at a discount, which is actually a great thing. That's the best thing about selling a put option. It's what I refer to as a non-losing strategy because the worst that happens is you get assigned and you don't have a whole lot of risk management to do because if you get assigned, well, it's not really a big deal at all because you basically go in with the intention of getting assigned. Okay. If we want to keep collecting consistent premium without having to manage our position too much, it's better if the stock stays the same price or goes up. Look, if it stays the same and just goes sideways, you won't get assigned. Getting assigned isn't bad, but I'm just saying you won't get assigned. So you really don't do anything. And it's better if the option that you sold becomes basically worthless. Then you can basically sell a put option again and just go for that premium collection, okay? So if the stock goes sideways and does nothing, it expires, do it again, sell another put option. And just keep going and sell puts until you eventually do get assigned. The further the stock price is from the strike price, the lower the delta will be, meaning that the small price movement in the stock won't really have large impact on the option's value because delta also measures that sensitivity to how that option moves. So if it's a low delta and the stock moves a lot, the option's not going to move a lot, okay? Delta measures sensitivity, so keep that in mind. By looking at your delta, you can get a sense of how sensitive your positions are to changes in the stock price. If your delta is too high, you may want to consider adjusting your position to reduce the risk. You may close that option and open something up with the lower delta. And you can do that by rolling the option to a lower strike price or by doing it to a later expiration date. Whatever gets that delta lower to really reduce that sensitivity, that's gonna benefit you if you want lower vols overall. And that brings me nicely into the next risk management tool, which is rolling, okay? As I talked about earlier, rolling an option just means that you're closing out your current position by buying back the put option that you sold and simultaneously selling a new put option with a later expiration date or a different strike price. This can help you avoid assignment if the stock is trading near your strike price or even below. You can adjust it by rolling, while also allowing you to collect additional income. So sometimes I roll for a net credit. Sometimes I roll for a net debit. I'm going to show you an example.
All right, so now I want to show you what rolling an option looks like. And since I do have many options that are expiring right now, I usually go to total return and I see if any options are at a loss. So right now I have just a lot of gains. All of these are gains. And I'm trying to look for a stock where I might be a little bit down. And if I'm down, I might look at rolling that position. So for the most part, I only have winners right now. There's an NVIDIA one, but that's a little bit of a different strategy. So what I'm going to do right now, since everything is essentially winning, I'm going to show you what I can do with Apple. So Apple is just slightly down. It's down 20 bucks, which is good when you're just winning and you're coaching a lot of people and everyone's just winning around you. It's just the most satisfying feeling. I love that. But this is kind of like the only losing, I wouldn't even call it losing. I'm kind of just flat on this sell put right here. What I would do is, let's say that, I don't know why you would be worried about Apple going down to 235 when it's at 247, especially because this option expires like in 30 days or so. However, I'll show you what a roll looks like. I don't have the best rolling example since I'm successful on every trade at the moment, but let's just say hypothetically that the stock was approaching 235, which is my strike price right here. Okay, I have a 235 put option, and let's say that Apple went down to 235 and you said to yourself, well, I'm a little bit nervous. I'm not sure if I want to get the stock at 235. I want to reduce my cost. I don't want to purchase it yet. There's multiple reasons why you wouldn't want to, right? In most cases, I do want to. But what you would do is you would simply just find a different expiration date and then you would roll down. I'll show you what that looks like right now. And it doesn't matter what brokerage you're using. You can use this on any brokerage. The whole point is you're increasing length of time because time for options is the most important thing. Like more time means more value for the option. So it allows you to collect income. It gives you a net credit, or even if you pay a debit, it significantly lowers your price. So I'll show you an example of both. All right. So look, 235, I can easily just go down to, well, this is going to be super profitable no matter what. As you can see, I increased the time by 63 days and I'm getting a total credit of $2,900. That's because, well, these 63 days mean a lot for options. So it's pretty crazy actually. You can see here how I'm moving from 235 down to 230. I'm literally saving $5. I'm going down by $5 and I get paid to go down $5. This is why rolling is super good. I'm gonna leave a video down in the description about rolling options as well if you want more information on rolling options, but I'm gonna try to give you everything right now, which is essentially rolling is the most powerful thing that you can do to fix a position. Rolling allows you to fix a position, it allows you to adjust the position, and allows you to make more money. And when it comes to selling a put option, rolling is really powerful. Although I will say that typically when I sell a put option, I want entry, so I don't need to roll. But let's say that you don't want to own the stock, or it's crashed a little bit, or there's a bear market, or whatever. Insert the reason why the stock went down, and let's say that you change your mind and you're not feeling as confident anymore. Well, either you can close the position entirely, or you can roll. So in this example, it's really easy to roll for a profit, right? So I'm just rolling down by $5 and I'm getting $2,900. So for example, you can also roll down significantly lower. So you can go down, for example, let's say that Apple crashed for whatever reason. They had a bad iPhone release and the stock went down to 200, okay? So first of all, that would be like an extreme event, right? If it went down that much, it would be crazy. However, even if it did go down that much, you can see here how you can roll from 235 down to 205. So you would still be at a loss if Apple went down to 200, but you would go from 235 down to 205 with just 63 days. You can give it 63 extra days, see what happens, and then you can roll again. Nothing's stopping you from rolling once, twice, 3 times, and so on and so forth. So you can roll and effectively get your average cost down to 0, which is pretty crazy, right? Obviously you need a long length of time, but imagine that every single 60 days or 90 days I could roll my position down lower and lower for a credit or a small debit. You can get the cost down to absolutely nothing.
I hope that example was helpful. Now look, rolling can also be used proactively to lock in profits. For example, if you sold a put option and the stock price has risen significantly, the value of the option will have decreased meaning you can buy it back at a much lower price than you sold it for. You can then roll the position by selling a new put with a higher strike price or a later expiration date to continue generating premium income. Another important aspect of risk management is paying attention to your overall portfolio size and the number of contracts you're trading. One of the easiest ways to get into trouble with selling puts is by trading too many contracts relative to the size of your account. Remember, each put option represents 100 shares of the underlying stock. So if you sell 10 put options, you're committing to buy 1,000 shares of the options that are exercised if they do get assigned or exercised. Make sure you're not over leveraging your account by selling more puts than you can comfortably manage. Finally, don't underestimate the importance of having an exit plan. Even though selling puts can be a relatively passive strategy, you still need to have a plan for what to do if the stock price moves against you and you change your mind on the stock. It's okay if it moves against you, but if you no longer like the stock, then you have to take basically some action. Will you roll the option? Will you take assignment and hold the stock? Will you close the position for a loss and move on to another trade? Those are all questions that you must ask yourself, and it does depend on a case-by-case basis, which is why I do a lot of live trading in my Discord community. Every situation may be different, and I'm trying to educate you as much as possible. So look, having a predefined exit strategy, to be clear, if you have a predefined exit strategy in place before you enter a trade, and that can help you basically avoid emotional decision making and keep you focused on your long-term goals. Having an exit strategy is very crucial. And that's it. Guys, you can see that this is very little risk for this strategy. And it's extremely straightforward on how to manage that risk. Now, when you're looking to sell put options on a certain stock, you might not know exactly what to look for. And that is very important. So this is where technical analysis comes into play. Technical analysis is very important, and there's a big debate on Wall Street. Is technical analysis more important than fundamental analysis? Others will say fundamental analysis is way more important than technical. I would say let's be in the middle. Let's use both. Let's pay attention to technical analysis, and let's also pay attention to fundamentals. While fundamental analysis helps you understand the company's financial health and long-term prospects of a company, technical analysis helps you identify short-term price trends, support and resistance levels, and market momentum. Technical analysis to me is actually more on the psychological side. It tells me what the psychology is of other people in the market, which is extremely important. I think this is more of a psychological game than a mathematical game. So for me, I do like technical analysis a little bit more. Fundamentals is also important. If you use technical analysis correctly, you'll be able to time your trades more effectively and increase your chances of success. That's all we can do here. I don't have a 100% success rate. Nobody does. Anyone claiming high success rate typically is not really being that truthful in my opinion. And I think it's much more important not to look at your win rate. It's much more important to look at your profitability, how much money you're actually making, percentage, and how much risk are you taking. And since this course is all about selling puts, we want to use technical analysis to tell us which stocks are not likely to fall in the near future and which stocks, if they were to fall, what are the safe levels of picking strike prices? For example, let's say that you've identified a stock that you'd like to sell puts on, but the stock is currently trading near or around the key support level. Support, by the way, is a price level where the stock has historically had a hard time falling below, as buyers tend to step in and push the stock price way back up. It's like they're saying to the market, hey, this is too cheap of a price, count me in. I want to buy up a lot of shares at this price. That's what support is. If the stock is trading near support, selling a put option with a strike price just below the support level is extremely smart. It's genius, okay? The support level provides an additional margin of safety. It gives you another data point. I'm all about data. You guys been watching my video, especially on the psychological video that I recently posted. Must watch that video. It's all about data. It's all about mindset. And if you're selling a put around the key support, you're a genius because you have multiple things that are in your favor for that put not to go into the money. Again, it's not a bad thing if it goes into money, but if you can win 9 or 8 times in a row on a sell put and then you get assigned, you're putting yourself in a very advantageous position. Similarly, you can use resistance levels to time your trades. Resistance is the price level at which a stock has historically struggled to move above, as selling pressure tends to increase when the stock approaches this level. If you're considering selling puts on a stock that's trading near its resistance level, it might be worth waiting to see if the stock pulls back before entering the trade. This way you can avoid selling puts just before a potential short-term dip, which could honestly result in you getting assigned, which is, again, not bad, but if you don't have to get assigned and you know the levels at which you can sell puts, you can do that over and over again and make it a repeatable strategy of just collecting income over and over again. So now I'm going to share my screen and show you Yahoo Finance and pick a good stock to show you some technical indicators on. I'm going to specifically go over selling puts using RSI and Bollinger Band, and I think that using simple technical analysis will definitely help take your selling puts strategy to the next level.
All right, what I want to show you guys next is we're going to take a look at the RSI and the Bollinger Band and some technical indicators that I use to really find an opportunity to sell puts and enter into a stock that I want to own at the proper price. Because if you don't sell a put option at the proper price, the stock could go down. So you obviously want to be aware of that. Like if you sell puts at a stock that's 52-week highs, like that's just not the best idea. However, it really just depends on the technical indicators. So even if a stock is at a 52-week high, maybe the technical indicators say otherwise. Here, what I'm using is a Bollinger Band. So the Bollinger Band here, I'm just using the standard 20 and 2. So I'll show you what that means. So if you go to Bollinger Band, you can see 20. This means that it's going out about 20 days, and 2 is a 2 standard deviation. Okay, standard deviation, you don't have to learn it. Essentially, a standard deviation is just something a little bit unusual from the norm. Think about it in terms of like, let's say human height. Okay, so if you're a man, you're 5'10", your son is going to be about 5'10". 1 standard deviation would be like 6'1". 2 standard deviations would be like 6'4", right? So like Barron Trump is like a couple standard deviations above Donald Trump because he's like 6'3" and his son's like 6'9". So it's really, really tall. So that's just what Bollinger Band is. It's looking at standard deviation, which is just like measuring what is normal and what's not normal. So you can see here that the range for NVIDIA would be 148 at the top or 128 on the bottom. So that's essentially a $20 gap here, and that's where you can expect NVIDIA to be like 95% of the time. That's what the Bollinger Band does. It tracks like what's likely to happen like 95% of the time if you're using 2 standard deviations. If you use 3 standard deviations, then it's going to be essentially 99% of the time, which you don't need. That's a little bit extreme, and it's excessive. You don't need that because then you're not going to be able to trade at all. You're going to be waiting for like a signal that's like really, really rare. So here, what we're looking at is NVIDIA is at the bottom of its Bollinger Band. So this is very, very cheap, and this is the perfect time to sell put options. This is as perfect as it gets. When a stock's near its 52-week low, that's good. When a stock's by its Bollinger Band bottom, that's good. So here is at the bottom and it bounced. Here it went towards the bottom and it bounced. And you see NVIDIA doing bounces like that. And right now, I don't think NVIDIA will go too much lower. I mean, we'll have to see what happens with the market here, but this is a really good sign in general. Like, you can't make a blanket statement and say 100% is always good, but I'm telling you, this is a really, really strong indicator. This is one of the strongest indicators, hands down, that I use. Now, when it comes to the RSI here is 36. That's also pretty low because as it approaches like 20, that means it's oversold, like really oversold. But 36 is also really low, so that's another good indicator of when to sell a put option. So if it's near the bottom of its Bollinger Band, that's good. And if it's a low RSI, that's also really good.
All right, hope that was helpful. And now look, one of the biggest key benefits of selling put options is the flexibility that it offers. As market conditions change, you can easily adjust and optimize your strategy to take advantage of new opportunities or reduce risk. Let's talk about some ways that you can fine-tune your put selling strategy as you gain experience. First, you can adjust the type of stock that you're targeting based on the market condition. For example, during periods of economic expansion, growth stocks tend to outperform, so you might want to focus more on selling puts on companies in sectors like technology, consumer discretionary, and industrials. These sectors tend to benefit the most from rising demand, higher consumer spending, and increased capital investment. On the other hand, during periods of economic uncertainty or market downturns, defensive sectors like healthcare, utilities, and consumer staples tend to perform better. These sectors are less sensitive to economic cycles as they provide essential goods and services that people need regardless of the state of the economy. By shifting your focus to defensive stocks during bear markets, you can reduce your risk and continue generating premium income even if the broader market is declining because you're in the safe companies. You're in the companies that are going to be less affected. And another way to optimize your strategy is by experimenting with different strike prices and expiration dates. Okay, this is actually a little bit more advanced. This is what I focus my one-on-one coaching students. Some of them have big portfolios. Majority of them have big portfolios, right? 6 figures. And we look at diversification across different expiration dates. So as you gain experience with selling puts, you'll develop a better understanding of how different strike prices and expiration dates affect your risk and premium income. You might find that selling puts with strike prices closer to the current stock price offers higher premiums, but also increases the likelihood of assignment. Or you might discover that selling longer term options provides higher premiums but ties up your capital for longer than you'd like. Tying up your capital for a really long time is good if you're getting the money that you want, but you don't want to tie it up for longer than it has to. So by experimenting with different combinations of strike prices and expiration dates, you'll be able to fine-tune your strategy to meet your income goals while also managing your risk effectively. You can also consider incorporating advanced option strategies into your overall plan. One of my favorite strategies of all time is the wheel strategy. Even though this is a course on selling puts, selling covered calls just complements selling puts. It complements it so well that I think it's one of the most important strategies that you should watch, because selling puts and covered calls together make up the wheel strategy. So if you have these 3 strategies, you have my 3 bread and butter strategies. And these 3 bread and butter strategies is how I've been making money predominantly with 80 or 90% of my capital. So you should definitely finish this video and watch my covered call in my wheel strategy course, which is the best course out there on YouTube, hands down. So a covered call involves selling a call option on a stock you already own, which generates additional premium income. This strategy can be particularly effective if you're assigned shares through selling puts, as you can immediately start selling covered calls on the shares that you own. For example, if you sold a put option on a stock with a strike price of 50 and were assigned the shares when the stock price dropped to 49, you can just sell a covered call at 50, 51, 52, 55. Anything above or at 50 would bring in income, give you a perfect exit plan, and this allows you to generate even more income while holding the stock and potentially benefiting from a bullish price movement. If you sell a 50 strike, obviously you won't have too much price movement because your average cost is 50. But if you sell a covered call that's above 50, then you get a lot of upside, so that's amazing. So with the wheel strategy, you'll be able to collect premium no matter if the stock goes up or if it goes down. Now, let's talk about the psychological aspect of selling put options. One of the biggest challenges you'll face when selling put options is dealing with fear and uncertainty, especially when the market moves against you. Let's be honest, there will be times where the stock price drops near your strike price or even below it, and you'll face the possibility of being assigned shares at a loss. And you may panic. In these moments, it's not about panicking, it's about having strong mentality, because if you panic, oftentimes it's literally the worst thing that you can do. So you want to have that long-term mindset. Many traders panic when they see a stock price approaching their strike price. And I will say that sometimes it's good to just roll down and to adjust the strike price, but in many cases it's not. When traders basically panic, this can lead to emotional decision making, like prematurely closing out a position, rolling at the wrong time, or avoiding future trades altogether out of fear, which I think is the worst of all. To succeed in selling puts, you need to have a clear plan in place for how you'll handle these situations before they happen to you. I cannot emphasize enough, guys, how important this is. This will prevent you from making illogical decisions when emotions are running high. Emotional trading is the #1 destroyer of profitability. Okay, you can learn all my strategies. You can even be in my Discord following my trades. But if you start panicking and closing trades and not following what I'm doing, as an example, you're not going to get good results, right? So let's go over an example. Let's say that you sold a put option on a stock that's 50 at a 50 strike price, and the stock is now trading at 48 with 2 weeks left to expiration. Many traders would feel a rush of anxiety at this point, wondering whether they should take action, whether they should close the position, and they're going to be worried, right? Because they're below their strike price. However, if you're prepared for this scenario and are comfortable owning the stock long term, you can approach the situation calmly. You might choose to roll the option to a later date, wait to see if the stock recovers, or even allow yourself to be assigned the shares, knowing that you're buying a high quality company at a discount. And I prefer the latter, which is just buying it at a high quality company. There's really not a problem in 99% of the cases, right? Unless something has fundamentally changed about the company. Having confidence in the stock you're selling puts on is the easiest way to get rid of emotional stress. If you're selling puts on companies you believe you're comfortable owning, essentially, and you believe in them, it becomes so easy. It's just easy money. So easy. Even if there's some short-term volatility that comes in, you're like, yeah, I don't mind. So you can take a more objective approach knowing that the stock is likely to recover. I mean, if you're trading Apple and Apple falls down 10%, you'd be kind of out of your mind to say, oh, Apple's going to go bankrupt. I mean, It's not, right? It's gonna be fine. So when you're in high quality companies, you don't really have to worry about that. Now, another psychological hurdle is greed. I'll be honest with you, we're all greedy. I'm greedy. You're greedy. Everyone's greedy. It's fine. It's normal human emotion, right? But when selling options or selling put options, it can be tempting to chase higher premiums by selling puts on riskier, more volatile stocks or choosing strike prices that are closer to the current stock price. While this might increase your short-term income, it also significantly raises your risk. Traders who give into the greed often find themselves assigned shares they don't want or facing large losses because they took on too much risk. To combat greed, it's important to stay disciplined and stick to your strategy. This means focusing on selling puts on higher quality companies and stocks with strike prices that provide a margin of safety. It's better to consistently collect smaller, safer premiums than to take unnecessary risk for chances at a higher payout. Because typically when you try to take shortcuts in life, they typically, you get what I'm saying. Some shortcuts are worth it and some are not. So take calculated risk. I can't say shortcuts in general are bad. When you try to chase premiums, that ends up being bad. You already saw my take on chasing. So look, patience is another key psychological trait that you'll need to cultivate. Selling put options is not a get-rich-quick scheme. It's a methodical, steady approach to generating income over time. Some months will be better. Some months will be a little bit lower. But in most months, you will be able to beat the S&P 500, especially on a risk-adjusted basis. And there will be times when you don't collect as much premium as you'd like, or when the stock price doesn't move in your favor. But over the long term, sticking to a disciplined strategy will produce consistent results. It's also important to manage your expectations. You might not hit your income target every month, and that's okay. Some months you'll collect more premium than others, and sometimes you'll need to roll your positions to avoid assignment. If you focus too much on short-term results, you'll be more likely to make impulsive decisions that could hurt your portfolio. One way to maintain your emotional discipline is by setting clear rules for your trades. For example, you might decide that you will always sell puts on stocks that meet certain fundamental criteria, such as your minimum market cap, positive earnings, and a strong balance sheet. You only sell puts with these strike prices that are at least 5% below the current stock price. Well, by setting these rules in advance, you can remove some of the emotions from your trading decisions. So when things don't go your way, say, hey, I did, these 4 factors, I've invested 5% below, I'm being a little bit emotional here. And you can call yourself out, which is really, really important. So look, another way to manage the psychological aspect of put selling is to focus on the process and not just the outcome, okay? In other words, instead of worrying about whether a single trade will be profitable, concentrate whether you're following your system and making good decisions based on your strategy. If you consistently follow a well thought out process, the results will take care of themselves over time. Finally, let's talk about the importance of detachment when it comes to managing risk and making decisions. Detachment means viewing each trade objectively without becoming too emotionally attached to the outcome. Okay, this is very important across many things in life. Detachment is important. This can be difficult for some traders, especially if they've been invested a long time or they put a lot of money into a position, which is why I always say risk management's important, because if your risk management's off, it actually makes your investment bigger, which affects your emotions. So it's all tied, right? So maintaining a sense of detachment allows you to move and make more rational moves with more data-driven decisions. So when you can detach and look at it objectively, that's very important. So for example, if a trade isn't working out as planned, it's important to be willing to cut your losses or roll the position without feeling like you failed. Because listen, it's not failure. You're in this game long term. It's okay if you have 1 losing trade or 2 losing trades. It's not a big deal. Every trader experiences losses from time to time. What separates successful traders from unsuccessful ones is the ability to manage those losses and move on without letting emotions cloud their judgment. Now let's shift gears a little bit and discuss how selling put options can be a powerful tool for building wealth over time. Many people are attracted to selling puts because of the immediate income that they generate. Because when you do sell a put, the cash enters your account immediately. Your cash balance goes up. Your account balance won't go up because you have a negative position, but you do have extra cash now, and you can actually withdraw that cash if you wanted to. But the real potential of this strategy lies in its ability to compound your returns over a long period of time. So as we've discussed, each time you sell a put option, you collect a premium up front. This premium is yours to keep, regardless of whether the option is exercised or it isn't exercised. It's already in your account. So over time, consistent collecting premiums can add up to significant amounts of income, like really significant. But what's even more powerful is reinvesting that income back into your portfolio to generate even more income in the future. So I personally reinvest a lot of my earnings, and that's why my portfolio keeps growing. And then I use my coaching income to live off of, even though my expenses are not that high. So both my portfolio and coaching income are above that. But hey, that's neither here nor there. I just want to point out that at a certain point, you're going to get to having enough income where you're so comfortable, you're not really going to think about your expenses. Option trading is really one of those things where the income really starts to stack up, especially in your later stages of your career of option trading. It's not that it's a career, by the way. It only takes an hour a week, right? In my Discord sessions, I have 45 minutes 2 times a week, and that's it. It's an hour and a half a week. And not even that, just some people just copy the trades without even getting on the call, right? So what I mean is like the career of you doing this, it eventually snowballs, because compound interest, it snowballs, and you get to a point where you'll make so much income well above what your spending needs are. And at that point, money just becomes like monopoly money. It doesn't really matter that much. So anyways, let me get back to the point. Let's say that you start with $50,000 portfolio and you sell a put option on a stock with a strike price that's 5% below your current market price, okay? So you collect an average premium of, 2% per month in this example, let's say. So $1,000, all right? We're gonna keep it very conservative, okay? So you make $1,000 on your $50,000. After 1 month, you have $51,000 in your account. If you continue to reinvest that income by selling more puts, your premium income will grow, because now 2%, another month will be 2% on 51,000. So you'll make $1,020, because now you make 2% on 1,000 extra, right? So it's 1,020, right? But now you have $52,020, and now you have 2% return. I mean, 2% return now on $52,020. Getting a little stretch here. We're getting late in the course. That's money. That's now going to be $1,044 or something like that. It compounds. It compounds and compounds and compounds. And it might not seem like a lot, but here's a picture of what a compound chart looks like. I know you guys have seen this chart before. Compounding is big. It's big. It's like the biceps over the triceps. All right. Sorry if I'm flexing or whatever. I'm just trying to have a good time here and make this course fun. All right. Hitting that little bit energy spike right here in the middle of the course. All right. So look, after 1 year, you'll have collected a lot of money if you're selling puts over and over and over on a monthly basis. And I just realized then it's 1,020, et cetera, et cetera, et cetera. So if you do a linear amount of money, right? If you think about how much you're making per month, it's $1,000. It's going to be more and more and more and more every single month. So you don't make $12,000 the first year with 2% per month. You end up making like, do the math here. I'm gonna put up on the screen because you can't do compound interest in your head, by the way. I have a rough picture of it, but it's gonna be well over 12,000. It's gonna be around 15,000. Here it is on the screen. So if you're following this, the first year you make this amount, right? In the second year you make this amount. This is without adding money, by the way. The second year. The third year you make this amount. In the fourth year it goes up, right? Fifth year here. Now check it out. I'm gonna skip a little bit. You might be thinking to yourself, okay, what if we go into year 10? How much will it be? Well, in 5 years, we've made this. In 10 years, we've made this. And if I do another 5 years and 15 years, we have made this. You can see how compounding becomes really big and non-linear, okay? So I want you to be aware that sticking to the long term here, and by the way, it took me 10 years to get one portfolio to $3.6 million, and then the other portfolio's probably around the same. It's a long-term portfolio. I do use a little bit riskier strategies, so I have grown it a little bit faster with a little bit more risk, but approaching 8 figures here in 10 years. Guys, it's possible for anyone to do it. I know it might seem out of reach a little bit, especially if you're like newer in your journey, but I'm telling you, this is the best investment of time and money that you can possibly make. It's the most passive. Selling puts is the safest and the most passive way to make money. So I just want to say that the compounding effect is one of the most powerful aspects of selling put options. Just like reinvesting dividends or capital gains or just buying more rental properties and just more and more property, it becomes juicy. And like I said, it becomes like monopoly money at a certain point. You stop thinking about money completely once you hit the 7-figure mark. I've seen videos on YouTube that will say wealth skyrockets at 100,000, and it is really true. Once you hit 100K, it skyrockets from there because now you have money making money. Okay, one of the most powerful things, having money is one of the strongest forms of leverage. It creates a snowball effect that can significantly increase your overall wealth. Year over year, it becomes easier. So if you don't have $300,000 right now, that's okay. You'll get there. When you have $300,000, when you make 2% a month income, it's $6,000. You reinvest that, it snowballs really fast. I have a lot of retirees or folks that are close to retirement. I have a dentist, he's 47 years in practice, right? Well, for security, I won't mention his name, but he's been in practice for 47 years. And every single year, his portfolio is snowballing, $2.8 million. You get like a 20% return, that's $500,000. becomes a lot. And in fact, look, I think that anyone can scale it. I truly believe that. Right? And the fact is, selling puts can be especially effective when combined with other wealth building strategies such as dividend reinvestment, dollar cost averaging. By layering these strategies together, you create multiple streams of income within your portfolio, all of which contribute to your long-term wealth building goals. So for example, let's say that you're selling puts on dividend paying stocks, okay? If you're assigned the shares, you're not only going to collect the dividend payment, but you also have the opportunity to sell covered calls on those shares, right? That's what I call the double dividend strategy, and I should make a video on doing the wheel strategy on the double dividend strategy. The double dividend strategy is actually something that I made up. I'm not aware of anyone else that has talked about that strategy, but the double dividend strategy is pretty simple. You pick a dividend stock, you do covered calls on it, and you can count it as two dividends because you have the covered call income and then you have the dividend income. And I will say when you sell puts, you don't collect dividends because you don't have the position yet, so you can't collect dividends. And that's actually why it's not bad to get assigned on puts, because then you have the shares and the shares can pay you dividends. So the combination of dividend income, covered call premium, when you do get assigned the sell put, and just selling puts premium in general, this is the most powerful tool for building wealth. This is how you build wealth fast, right? So look, don't worry if this whole theory seems a bit overwhelming to you. I'm going to go over a ton of real world life examples later on in this course. I'm just giving you all the theory because I'm making this course the best course on YouTube. I hope that this course makes you subscribe, and I hope this course also makes you consider that I'm the best option coach in the world, and I'd love to help you if you want help. And if this course gave you enough value that you don't need help, it's fine as well. In my Discord, I typically just do trades, so folks get to look at what I'm doing, they get my personal attention, and I do one-on-one coaching as well. So I clean up portfolios, I talk about more advanced topics as well and how to make money, especially if you have 6 figures. It's a no-brainer. So you can check out the first link in the description. But hey, subscribing is also enough for me. I'm perfectly happy with that too. My goal is just to teach and educate, make you some money. So look, let's talk about how this strategy might play out over the next several years for a medium-sized account. I want to go over some specific examples. And keep in mind, this is just a standard example to give you a ballpark range of how much you can make off of selling puts. And if you have a smaller account, keep in mind that you could technically make the same amount of money, actually even higher amounts of income as a percentage basis, lower dollar figure, higher percentage, by turning these sell puts into a put credit spread, which I did cover earlier. However, it is a little bit higher risk, as I did mention. So look, let's say you're my standard student, 50K, 100K, let's use 100K. Let's say you have a 100K portfolio and you're selling puts on a diversified mix of high quality stocks. You aim to collect an average of 2% in premium, which amounts to $2,000. After 1 year, you've collected well over $24,000 in income, and you've grown your portfolio to, around $130,000. In the second year, you reinvest that premium income by collecting and selling more put options. Over time, this steady income stream, by the way, just compounds and you get crazy long-term gains. One aspect of selling put options that often is overlooked is the importance of tax efficiency when it comes to selling puts. If you're looking for an accountant, by the way, or a tax advisor, I am not one, but I can connect you to mine, so you can email me. In the description, I will leave you my email, and I'm fine to connect you with them. I don't really mind. I'll just send you his contact, and you guys can work together on the tax strategy. But I will go over some general tax strategies that I do want to cover. When it comes to selling puts, there's not a whole lot of tax advantages unless you're doing long-term selling puts over 1 year, which would qualify you for the long-term capital gains tax. Otherwise, I do get questions about creating LLCs for option trading, which I think in most cases is not worth it, but it is possible. So if you want to send an email, I could potentially just connect you. But in terms of tax strategy, it's a little bit more favorable on covered calls because you can hold long-term covered calls, and the stock appreciation, there are some situations where you don't have to pay taxes. But when it comes to selling puts, for the most part, it's short-term capital gains. So look, now let's talk about generating consistent income from selling put options, which is obviously incredibly rewarding. I think that's pretty clear. It's also crucial to understand that managing your tax liability is really important. So although most of the time it is short-term capital gains, the more cash we can hold on to, the better. So one strategy I do have is I do sell a lot of my losses at the end of the year to capture in that tax loss for that year, and then I buy back a similar position. It's a little bit more advanced, so I can cover that more in my one-on-one coaching. I just want to bring these things up so you're aware that there are certain strategies that you can use to save on taxes. Another important consideration is the wash sale rule, which can affect your ability to take advantage of tax loss harvesting when trading options. The wash sale rule prevents you from claiming a loss on a security if you buy the same security or an option to buy the same security within a 30-day period before or after selling it at a loss. So this rule applies to option trading. So if you're selling puts that are assigned shares, you end up losing money on the shares. And I pay my taxes, I pay a lot of taxes just to be safe with the IRS. Don't touch that stock for like 30 days. Otherwise, you can touch it, but it's gonna potentially be a wash sale rule. And that's because the IRS doesn't want you just selling a bunch of stock. You get a loss and then you rebuy back the stock. It makes no sense because you just bought back the same thing that you lost money on. There is a little bit of a loophole and a trick by buying similar stocks, but I mean, it can be a case-by-case basis, right? Obviously, I'm not an expert, but you want to be careful with the wash sale rule because the wash sale rule, it can cost you a lot of money. If you're buying back similar securities and the IRS says, hey, this is a similar security, you're not going to be able to write that off as a tax loss harvest. It's not going to count, okay? So you want to be aware that the wash sale rule is basically a 30-day period where if you do get assigned on a sell put, and let's say you don't like the stock, which I don't know why you would sell a put and you don't like the stock to begin with, so you shouldn't even have this problem the way I teach it. But let's say that you sell the stock, right? You should not sell another put because then if you sell another put, you have a very similar position and that's going to be disallowed. It's going to be disallowed for tax purposes. So if you experience a loss and you sell another put, it's not going to count as a loss. If you have a loss, you want it to count as a loss because then it helps your tax efficiency. It helps you reduce your tax burden. The lower your tax burden, the better, right? You want to legally reduce your taxes to the lowest amount possible. Now that I've covered tax efficiency, let's dive deeper into the role of volatility in selling put options. You guys want to make money? I think volatility is really exciting. So look, with volatility can come assignment in managing the stock or managing the position better, because with volatility, it may hit your strike price, which may sound scary, but listen, you don't want to actually react to volatility. When you sell a put option, one of the two things will happen. Either the option will expire worthless, and you'll keep the premium without any further obligation, or the option will be exercised. If the volatility is high, it goes into the money, it will get exercised on the last day. Let's talk about early assignment because it is possible for you to have early assignment. And I know that's a very scary thing. A lot of my students are afraid of early assignment. Let me explain one thing first. Although I don't purposely try to get assigned, I actually get excited when it happens because I know that I'm getting a high quality company at a good price. However, it's still important to be prepared for this scenario and have a plan in place for managing the stock position. Look, early assignment is rare. Why is it rare? Let me show you an example.
So I just want to point out that early assignment is really, really rare. So as you can see here, I have a 132 put on NVIDIA, and NVIDIA is like, a little bit under 132, somewhere thereabouts in the market. But I just want to show you an example of even something different where it's really, really in the money, where it still doesn't make any sense to exercise. So if I go for an option that's like, say, January 17, and I go for a let's say that you hold a 140. This would not make any sense for early assignment to happen because let's say that, you sold a put option. Why would someone exercise and put shares to you? You sold a put option. Why would you get assigned when the stock's at 132? The premium is $13.65. So why would someone exercise? Because the 140 put, if they exercise, they would make about $8, right? Because the stock's at 132, it's $8 in the money. So why would you want to make $8 of the stock being $8 in the money if you sold it, you have 140, stock's at 132, it's $8 deep. So if someone were to exercise, they would put you the shares at 140 and the stock's worth, 132. So they made $8. But why would they do that? Why would they make $8 when they can just sell the option for $13.65? And this is true up until basically the last day, which is why early assignment happens almost never. The only time early assignment happens is if the stock just crashed and the delta is 80, 85. It's really, really high. If it's really high, then yes, maybe you'll get assigned if there's not that many days left. But even if it's an 80 delta and there's a month left, still no one's going to exercise because there's more premium on the option itself to just sell the option or buy the option. Just trading the option itself is going to be better for that person up until the last few days. So you never have to worry about early assignment. It almost never happens unless the stock is deep in the money, super deep, 80 delta, and there's 2, 3, 4 days left, then sure, your chances do increase.
Look, if you're assigned shares, the first step is to evaluate whether you want to hold on to the stock or if you want to sell it. If the stock has dropped below your strike price, you might be sitting on a paper loss, but that doesn't necessarily mean that you should sell it. If you believe the company looks strong in the long term and the stock is undervalued, holding onto the shares is not a bad play at all. At the end of the day, you don't technically realize any losses until you sell the stock for a loss. In fact, being assigned shares at a lower price can be an opportunity to dollar cost average into a long-term position. I actually use selling puts as a stock entry strategy. By purchasing the stock at a lower price, you reduce your overall cost basis, which can improve your returns if the stock rebounds. If you have the capital for it, you can keep selling puts on the stock, keep going. You got to sign, keep selling puts. Keep lowering your average cost with premium coming to you. If you get assigned again, so what? You just lowered your price again. You can keep selling puts over and over again as long as it doesn't go above your threshold of your capital allocation. For example, if you have 500K, you go 10K on a sell put on Palantir, you do like 2 or 3 contracts, right? Palantir is around $42 a share. You go for 2 or 3 contracts, you get assigned, so what? Do it again. Go another 10K, another 10K. It's fine. You have capital enough to do it. Here's an example. Say that you sold the put contract for a stock at 50 per share and you got $2 premium. Now, let's say that you got assigned the stock at 50 per share. Your cost basis is 48, meaning you technically paid 48 per share because you paid 50, but you got $2 in premium, okay? Now, let's say you sold an equal amount of put contracts again, but this time at $45 for $2 per share, all right? Here we go. So the first time you sold some puts at 50, right? You can see here on the screen, you sold at 50, you got paid 2. Now you sell an equal amount of, say you sold 10 contracts, now you sell 10 more contracts at 45. You got assigned again. Your average cost is now 10 contracts at 50, there's 10 contracts at 45, okay? That center, your average cost is now 47.5, okay? Now mind you, if you've collected $2 in premium once, and you collected $2 in premium again, okay? Your average is technically not even 47.5. Your average is technically, because you've collected $2 on all 20 contracts, you can take off 2 from 47.5. Now you're at 45.5. Okay, so your average cost is a lot lower, and you can mix it up. Let's say that you sold the first contracts at 50, right? You got to pay $2. Cool. Now, let's say that you sold the second contracts at 45. Let's say you only got $1 for it. I don't know why that would happen, but let's say you only got $1 for it. That's fine. Your average cost is 47.5, and now 2 and 1, the average is 1.5. So 47.5 minus 1.5, you got 46. Your average cost is still going down. Every time you sell puts, your average cost goes down. Sell more puts. I'm always selling puts. So assuming that you sold an equal amount of contracts for both times and you collected $2 in premium both times, you've reduced your average cost by $2. In theory, you can get your average cost down to 0. If you sell a 45 put, you don't get assigned. What do? Sell it again. Don't get assigned, sell it again. If you do that, in theory, 20 times in a row, you've collected $40 if it's $2 each time. All of a sudden, you've collected $40 and you get assigned at 45, your average cost is 5. So it's pretty crazy. So that means that you keep collecting premium over and over again. And every time you collect premium, you'll be lowering your cost basis. And eventually, when you get assigned, your cost basis is so low, you're going to be in the green no matter what. You're just rolling in the dough of premium, all right? So, I mean, that's a really good position to be in. I would say that's kind of the goal. The goal is fine either way. You get assigned, it's fine. You get premium over and over again, that's also probably preferred, but either way, I'm putting you in a position to make income consistently. So let's talk about a rare situation where you might just sell and take a loss, okay? If the stock's fundamentals have deteriorated or you no longer have confidence in the company, it may be best to cut your losses and sell the shares. This is where it's important to have a closer look at your exit strategy in place, because before you enter a stock, you want to think about where you're going to exit it. You know, it's like your ex-wife. You know, she came, she had an exit plan, and she left. I'm just joking. Well, I'm not. I work with a lot of guys that are divorced. I hate to see it. So I always want to help those guys especially. My parents are together, but I always want to help. I want to help everyone, and I hate to see people in pain in any area of life, right? I make jokes, but I want to say that. Hope no one took that joke personally. Look, decide in advance what conditions would lead you to sell the stock, okay? You always want to have that exit strategy in mind. Whether it's a certain price level, right? A change in the company's earnings outlook or a shift in the broader market, all right? You want to pay attention to that, guys. I mean, you really want to think about your future. You want to have it all planned out, okay? I know that's not possible, like with the example I just made about divorce and stuff. Things happen in relationships, right? The same in the stock market, guys. You know, you come into the position one way and it looks a little different, right? Time could shift your perspective on the stock. Time could shift the company's fundamentals. Time could shift the technicals of the company. Things change, guys. That's why the market has opportunities, is because there is changes that happen in the market and you got to plan accordingly for it, and you can't fall into a fallacy, and that leads to losses. Okay, so I want you to stay at the top of your game, because this is a long-term race, not a sprint. It's a marathon. That's what I was looking for. Hope you appreciate the length of content I'm making here, staying focused here, because I think this is a very important topic, but it's a long-term marathon, not a sprint. All right,
guys, as you know, it can take months to build a valuable course like this, from the research, from the editing to the cost of editing. And I just want to say that if you want to learn options as fast as possible and retire, I'd be more than happy to coach you one-on-one and teach you exactly how I trade options, show you all my trades, and work with you one-on-one. So if you're interested in that, go ahead and click the first link in the description. And thanks so much for watching this entire course.